All right, so welcome to Quantitative Finance 301. This video is going to be all about factors and factor regressions. And when I say factors, these are sometimes referred to as style factors or investment factors or risk factors or sometimes risk premiums, right? They all refer to the same thing. And in this video specifically, we're going to be looking at factors within the stock market. So we're talking about things like the ERP, right? The equity risk premium, size, value, momentum, profitability, quality, low vol, right? Things like this. These are examples of equity factors. So just to give you a little sneak peek of one of the things that we're going to be building up to in this video is we are going to be performing our own factor regressions directly inside of Python. But even if you have no background in Python, and even if you're not a software engineer and you don't have any programming background at all, I would still highly recommend you stick around. It's only going to be a sliver of the video, maybe just like 10% or 20% at the very end of the video where I actually share my screen and cover the coding part. The bulk of the video is essentially just going to be this dump of context and information and knowledge about what these factors are and why they matter. And just as importantly, actual insights and ramifications and implications for actual portfolio management. It might even start to change the way you think about your own personal portfolio. I think it's quite actionable, and depending on what you're studying and where you're coming from, it might actually fill in some crevices and gaps or cracks in your own knowledge, especially within the field of asset pricing. This is just a little preview of what we're going to be building up to once we actually get to the coding part. It's actually incredibly simple. We're just going to be importing the stats models library within Python to actually perform the mathematical OLS regression. So there's really not that much code. As I mentioned in some of my other videos, what I do is I actually tend to pull, just for example, right, the Fama-French 5-factor model, and then we're actually going to be pulling the momentum factor and then appending them together and then running essentially 6-factor regressions, right? So that's just one thing that I like to do, right? Certain things might not be available on Portfolio Visualizer or whatever. That's just one sneak peek. But once we go over the code and the math, you're obviously free to run these factor regressions against any factor model of your choosing. So with all that being said, let's go ahead and take a step back now and start to dive into what these factors are and gain some context. Just a quick interjection, just so you guys know, if you do make it to the end of the video, I actually also cover rolling factor regressions. I completely forgot to do this at first. I got all the way to the end of the video, and then I remembered, and I definitely wanted to add it. So just to let you know, in addition to regular factor regressions, where we just get coefficients over the entire sample, we do rolling factor regressions with something called a rolling window or a sliding window, and obviously we end up plotting these visually so we can see how these factor loadings or how these factor coefficients vary throughout time. Definitely wanted to include this. Just wanted to let you know that this is going to be covered in this video. Okay, so the video that you're watching right now is technically the 5th total finance video on my channel. I have 4 different previous finance videos, and they fall into 2 different categories. So I just want to make sure that we're all on the same page here. Now, this video, probably, by the time I'm done, is probably going to be quite long. So, as always, I'm going to have timestamps linked in my description. So, feel free to just skip ahead, obviously, if you're not interested, and you want to go to the next chapter. But I just want to make sure we're on the same page here. So, these 2 videos up top, called Quant Finance 101 and Quant Finance 201, these are Python-based programming videos. These 2 videos are more or less just programming. And then these 2 down here, Market Efficiency and Asset Pricing 101, these are non-programming videos. These are just raw finance videos where I just share some slides and just share some knowledge. So just so you know, now the video that you're watching right now is sort of like a hybrid. It's mostly non-Python, and at the end it will be some Python. So if you make it all the way to the end and you actually want to code along with me on Python, this one here called Quant Finance 101 is going to be required. It is going to be a prerequisite. This is just a 9-minute video where we just sort of blaze through super basic foundational, just fundamental stuff. What is risk? What is return? How do you calculate it? What's Pandas? What's NumPy? What's Y-Finance? How do you source data? How do you calculate annualized return, annualized volatility, drawdown, plotting? It's super basic, super foundational. If you make it to the coding stuff, I will be assuming that everybody watched this. If not, it's no big deal. This one called Quant Finance 201, this was a really interesting video. It's definitely not required at all for this video. This video, we actually did stochastic modeling of the stock market. We specifically used a non-mean reverting stochastic model known as geometric Brownian motion, which essentially mimics how the stock market behaves. We also went over some Python notebook stuff, interactive plotting, IPy widgets. We actually also covered some time complexity stuff as well, how we can actually make our our code, how we can make our vectorized code essentially more efficient and run faster. It was a really cool video, but it's definitely not required for today's video. The market efficiency video, of course, it's recommended, but it's not technically required. The asset pricing video, the asset pricing 101 video, though, this is what I wanted to talk about. If you have a lot of asset pricing context and knowledge from reading research, maybe you're already familiar with this, maybe you studied this in school. If you have a decent background in asset pricing, you definitely do not need to watch it. But if you're kind of coming in fresh, I would highly recommend you watch it. This video right now that you're watching, it honestly could just be called Asset Pricing 201. It's essentially in spirit, like a direct continuation of that video. I'll probably be giving like a little bit of a recap, but then we're going to get into a bunch of stuff that builds on the concepts introduced in that video. It is quite long, but to be completely honest, you can honestly just bang it out in like 2x speed real quick. So if you don't have like a solid foundation in asset pricing, I would recommend you just give it a watch and then come back. So what actually are factors? So factors, also known as risk premia or risk premiums, how I would define essentially what a factor is in my own words is I would say that a factor is a quantitative characteristic that's shared across a set of securities. Another way I might define it is essentially factors are an underlying independent source of return, or even better, an underlying independent source of a risk and return. The risk part is equally as important. So as I said in my last video, I'm not gonna sort of cover the same ground twice. If you don't know what I'm talking about, I obviously would recommend you watch that last video. But factors essentially exist in more or less every single asset class. So these are just some examples. There's really only two factors that exist within bond markets. We have term and credit. Term is sometimes referred to as duration. In this video, we're just going to be focusing on factors within the stock market. This is just an example of some factors within the stock market. Now, I'm going to explain what factors are using an analogy. I used a similar analogy in my last video, but this is going to be a little more in-depth. So I like to use a food analogy. So let's talk about assets, and then we'll talk about factors. So assets, in my opinion, right, just with this analogy, assets can essentially be analogous to foods. So these assets could be anything. These could be, right, in this case, I'm just showing some ETFs, but an asset essentially, right, it could be an ETF, it could be a mutual fund, it could be a hedge fund, it could be any type of fund, it could be a private manager, it could even be your own personal returns in your own personal portfolio. In fact, what I do personally is I actually look at my brokerage monthly account statements, and I take my return for all of my investment accounts, and I put it into a CSV, and then I actually geometrically link them, run my own performance analysis, even run my own 5-factor and 6-factor model regressions against my own personal portfolio. And then if you pair that with like inflows and outflows, you can back out both like money-weighted and time-weighted returns. We could probably actually do a whole video on how you can even benchmark your own portfolio inside of Python. Either way, so I'm just using some ETFs here, but this really could represent any sort of fund. And the point here in my analogy is that funds are analogous to foods. So let's just say that these random 5 ETFs are analogous to these foods. Now, at first glance, these foods might look quite different, right? They all have different tastes. They're all from different cultures or different places around the world. You might need to go to a different food store or a different restaurant to purchase the ingredients or to order each food, right? Somebody might like burgers but dislike pizza, right? They seem like different foods to the person eating the food. But if we ran this quote-unquote factor regression, right, on the foods, we're actually going to see something different, right? So running this sort of, with this analogy, if we were to do a factor regression on the foods, that's basically like using X-ray vision in looking past the first layer of information through to some underlying variables. So anytime you hear the term factor regression, you can honestly just think like X-ray vision. We're going to look beyond the packaging of the food, being hamburger, hot dog, pizza, taco, and we're going to look through to, let's say, the underlying calories, macronutrients, and micronutrients, right? And if we do this factor regression now, we're going to see that even though these foods look quite different, they all behave incredibly similar, right? Now, first of all, the ingredients are quite similar. They all involve some form of bread or bun, some form of meat, some form of maybe lettuce or a tiny amount of vegetable, right? But the part that I'm actually getting at is they're all probably going to be quite calorically dense, right? They're all high in calories. They're probably all high in fat, right? So they're actually quite similar from the point of view of the food. Now, if we want to keep this analogy going, let's say that you really like pizza and you eat a lot of pizza, and you're putting on weight, and let's say that your doctor says you need to like stop eating pizza here, right? And the point that your doctor's making is you need to stop eating calorically dense foods, you need to stop eating fast food, you need to stop eating foods that are high in fat. Can you just stop eating pizza and start eating burgers instead? Obviously not. The burger's also high in fat, the burger's also calorically dense. To your body, it doesn't actually change anything. To your body, all these foods essentially act the same way. That's sort of what the factors are. The factors in this case would be the calories, the fat, the protein, whatever. We can keep this analogy going now, and instead of doing the factor regression on the food, which would be looking at the nutrients, let's do a factor regression on these funds. Now, if you look at these funds, I just kind of pick these ETFs, right? But if you look at these funds, at first glance, they might look different. They're, they have different names, different inception dates, they're coming from different fund providers. But if you look at these funds, they all have commonalities. They all are within United States markets, they're all within the stock market, and they're all tilted toward either large cap stocks or tech stocks, right? The NASDAQ is tech heavy. The other ones, I think almost all of them are targeting IT, technology, right? They all have commonalities. If we now do a factor regression on these funds, let's say that, in general, large cap tech or large cap growth is going to be, negative on the size premium since they're all tilted toward large caps, and they're all going to be negative on the value premium. Value just means cheap stocks. These are all tech stocks and growth stocks. These are all expensive stocks, so they're going to be negative on the value premium, and they're all regular, long only, more or less kind of broad market funds. So they're probably going to have a market beta of around 1, maybe just slightly more than 1 because they're a little volatile, whatever, right? If you run a factor regression on all these funds, this is what you're going to get. And the takeaway here is that, if tech stocks do bad, all of these ETFs are going to do bad, right? Or let's say, if it's a good time for size and value, all of these ETFs are going to perform poorly. If it's a bad time for size and value, and it's a good time for growth and tech and large caps, all of these ETFs are going to do well, right? They're all going to do the same thing because they're all exposed to the same factor. That's essentially what I'm kind of trying to get across here. So in other words, a good way to put it is that a factor is a commonality outside of the asset. And all investments that are exposed to that factor, right, to that commonality, are all going to act in a similar way. That's kind of how these factor stuff work. And then, of course, on the flip side, if you want to look at another analogy, we can say, these are just all examples of small cap value ETFs, which are all analogous to, again, a certain type of food. If you, eat a bunch of vegetables and then switch to a different fruit or vegetable, again, they're all high. They're all not calorically dense, right? They're all calorically sparse. They're all low in calories, they're all low in fat, they're all high in micronutrients, right? To your body, it doesn't matter if you eat a banana or a strawberry, it's similar. That's kind of the point. If small cap value does well, all the small cap value ETFs are going to do well. That's kind of, I guess, the point I'm trying to get across here. Now, of course, I'm giving incredibly clear-cut, obvious examples. Obviously, if small cap value does well, the ETFs that track small cap value are also going to do well. It almost seems obvious. But the point here is that maybe there aren't going to be funds that advertise their tracking factors. Maybe somebody's going to pay a very high fee to a manager that says we have this skilled management team that's going to find true value add opportunities. Like we're going to find a true alpha, true excess return. We're going to talk about this later. And then in reality, you can go and back out factor exposures of that opaque fund. We're going to talk more about this later. I'm just sort of making it as simple as possible for now. So as I said in my last video, I'm just going to blaze through this, but as I said in my last video, you can think that these factors always existed within financial markets, but they actually needed to be discovered and published by researchers. The first single factor asset pricing model within equities was called the CAPM, the capital asset pricing model. That brought to light the ERP, the equity risk premium, known as beta. I don't want to waste too much time on this. And then, of course, in 1992, there was a seminal paper published by Eugene Fama and Ken French called The Cross-Section of Expected Stock Returns. That essentially brought to light the value factor and the size factor. And then they added on in the 5-factor model, the profitability factor and the investment factor. That's the Fama-French 5-factor model. In this video, we're going to be adding on momentum. There's also another one called low vol. We can talk about that later. AQR actually calls it BAB, B-A-B, betting against beta. Again, the Fama-French factor models is just one asset pricing model. I mean, it's a couple, 3-factor, 5-factor, but I'm saying like the 5-factor Fama-French model is just one model. You can use AQR models. You can use a Carhart 4-factor model. There's a bunch of different models, right? Sometimes profitability will also be referred to as the quality factor. AQR calls it quality. They actually call it QMJ, quality minus junk. We'll talk about this later. That's just sort of, a little more background. So let's get into this. Moving on. So you probably understand what a factor is at a high level, just in the sense that it's an underlying commonality shared by a set of securities, and if the factor does well over a period of time, a stock with exposure to the factor might also do well, and vice versa. That's really not that hard to understand, but now we need to go deeper. So this is like the last sort of recap from that video, and then we'll get into some completely new stuff. But let me go over like a super simple example of why factors exist, and more importantly, why positive exposure to a factor pays you a premium, pays you an excess return, and then negative exposure to a factor will be a drag on returns. Why, why does this mechanism happen in the first place? A really easy example would just be to understand why the equity risk premium exists. Let's just say that in this example, in this universe, there's only two things that you can invest in. You can either invest in treasury bills, where you loan the treasury money. This is extremely safe. In general, in finance, we consider 30-day T-bills to essentially be the risk-free rate. So you can loan money to the treasury, and it's more or less 100% guarantee they're going to pay you back with interest, right? It's a very safe investment. Or you can invest in the stock market. Now, obviously, the stock market is very risky, very volatile, and crashes frequently. So if there's two choices in this universe between a very safe investment and a very risky investment, which one would you pick? Now, when we think about things in finance, we sort of need to think of like equilibrium models and stuff, right? Every asset needs to be held by all the market participants in equilibrium. We can talk more about this later. But if these are the only two choices and all investors still need to hold all the T-bills and all the stocks, essentially what happens is the stock market has to offer investors a higher expected return in order to incentivize them to hold the risky asset, right? If if T-bills and stock market both had the same expected return, you'd obviously take the one that's less risky. So therefore, if one is safe and one is risky, the risky one has to offer you a higher expected return. Most people will just have some intuition that risk and return obviously should be in some sense correlated, and this 100% shows up in the data. In fact, I'll actually tab out here back into Python in a second, and we can literally just run like a simple backtest of ETFs between T-bills and the stock market. The stock market's going to be way more risky, and it's going to provide way higher returns. That's the equity risk premium. It's really simple to understand. And then again, the reason why it's called a premium is because it's not just giving you a positive expected return in absolute terms. The ERP is the return on the market minus the return on the risk-free rate. The premium needs to be positive, which means that the stock market needs to provide you with an expected return so high, then it's higher than treasury bills. And then if you watch my video, the one I said that wasn't required, and it's not, but if you watch my video, not on asset pricing, but on market efficiency, I actually explain the mechanism for how the stock market gives you that higher return. It essentially comes in the form of investors placing a higher discount rate on the cash flows that the market gives you. So this is just like a super simple, just basic backtest, just to highlight the principles that I showed on the previous slide. I'm just pulling data here from an ETF called BIL. This is just extremely short-term United States Treasury bills. And then VTI, this is just an ETF for the total United States stock market. And we're just going to go ahead and run this, and we're just going to plot the cumulative returns into a plot. And this is exactly what we expect to see. The stock market is very risky, very volatile, crashes frequently. This is undesirable for an investor to hold, obviously. And then as such, over time, we can clearly see that it provides a much higher expected return. And then we look over here at the short-term treasuries. It still is giving you a nominal positive expected return over time. It's very, very safe, which is nice and desirable to hold. But then as such, you're not obviously going to be compensated for bearing that much risk. So that's really just the general principle behind the ERP. If you buy index funds, you're literally just harvesting the premium for holding an undesirable asset. That's essentially just how risk premiums work. And a similar thing applies to the rest of the momentum, size, value, profitability. We'll touch on those in just a second, though. Cool. So moving on, I'm just going to give one more example. Again, we're just going to gloss over this. of how a credit premium might work, just because, again, in my opinion, this is really intuitive and simple to understand. The same principle applies just so you can see how risk premiums function mechanically. Let's say that in this universe, you have two different choices of who you can loan money to. You can either loan money to the Treasury, and they're almost certainly going to pay you back. That's just T-bills, same as the last slide. And then in this case, let's say that you can loan money to some extremely risky tech startup that might go bankrupt and you might lose some money, or at the very least, you might lose your coupons, right? And then again, if these are the only two things you need to hold and everybody in this investable universe has to hold, all of these bonds, essentially, again, the guy with the risky credit is going to have to compensate investors with a higher expected return. In fact, the same thing happens even with your own personal credit score. That's why if you have a worse credit score, you're going to have higher rates on your line of credit or whatnot. It's a similar thing. This is technically a risk premium within the bond market now called the credit premium. But again, literally the principle is a riskier asset has to, over time, on average, if you buy 1,000 different bonds from 1,000 different companies, on average, you're going to get a higher expected return. That's really all there is to it. Now, again, same thing. We can go ahead and run a backtest in Python, just again, so you can get some intuition as to what a risk premium is. Again, this is on the bond side. We're going to run a backtest between two different ETFs, one called GovT and one called USIG, right? USIG. And this is essentially the difference between government bonds and corporate bonds, right? Government bonds are generally incredibly safe. And then corporate bonds, of course, there's different credit ratings within the corporate bond side. We don't need to worry about too much. In general, government bonds are a lot safer than corporate bonds. Therefore, corporate bonds, they're riskier asset, has to compensate the investor with a higher expected return over time on average, right? So we can literally go ahead here, and I'm literally just running a backtest between the government bonds and the corporate bonds. I already ran the cell, and this is what we see. Of course, they're both still bonds, and the corporate bonds are still, investment grade, decent corporate bonds. They follow a similar path, but obviously over time, the corporate bonds are giving a much higher return than the government bonds. This is something that we call the credit premium. There's a bunch of different risk premiums out there for you to harvest. Cool. Moving on. So let's just sort of gloss over the rationales behind the rest of these sort of equity stock market factors. Size, SMB, small minus big, means that smaller stocks are riskier than bigger stocks, so they need to provide you with a premium. In reality, the premium went away once we got better crisp data, and we sort of discovered that there was actually a delisting bias. I said in my last video, there's a really good paper called Size Matters If You Control Your Junk. You sort of need to filter out these junk stocks, which is small cap growth with weak profitability. Anyways, we can sort of talk about that later, but the rationale is that size should do better than big, but it doesn't actually, so there's a little nuance. Value, HML, we're talking about book to market. Rationale is that cheaper stocks need to provide you with a higher return than expensive stocks, because if a stock is cheap, there's something wrong with it. It has poor metrics, right? That's essentially how value works. Value and profitability, robust minus weak. I explained all of that stuff in my market efficiency video at the end of that. I'll put a little thing in my YouTube video right now. You can watch that if you want to learn about that. Investment, conservative minus aggressive. We don't need to worry about that too much for now. But what I really wanted to bring up is the momentum factor and also the BAB, the low vol or the betting against beta factor. I said this whole time that these factors are risk factors and they're all riskier. And because they're riskier, they need to compensate you. And that's true. But for some factors, they might not be true risk factors. They might arise for other reasons. Again, I talked about this in the other video, but there's no real reason to say that stocks with positive momentum are riskier than stocks with negative momentum. There's no real reason to say that. Now, some people will say it's a mispricing, and maybe the mispricing will be arbitraged away, maybe it won't. Some people say it might be data mining, but we have a lot of data for momentum and these other factors. Low vol is a really interesting one. It's almost the inverse. Why would, on a risk-adjusted basis, why would a safer, lower volatility stock give you a higher risk-adjusted return than a higher volatility stock? I could probably make a whole video on that. Momentum, there's something called PEAD, P-E-A-D, post-earnings announcement drift. Now it's massively mitigated. It used to be much higher in magnitude in the past, before it was more known and widespread and stuff. Momentum's almost like a longer-term version of PEAD in a way. Now, one of the reasons why these things might exist that isn't based on risk is the trades of non-profit seeking market participants like central banks and stuff. I mean, there's a lot to this, and we can talk about this later, but more or less you can almost think of these things as being risk factors. So now we're going to move toward the territory of factor regressions. So again, a super simple example, just with a CAPM through the single factor lens is, let's say your fund manager or your own personal returns in your portfolio, you got 12% in a year, the market maybe did 10% in a year, so you think you overperformed. And then again, when you do the factor regression, these asset pricing models have explanatory power. You might realize that the beta, meaning your sensitivity to the market, was 1.5, and the whole point of a factor regression is to determine the beta. We'll talk about this in a second, but essentially, right, if the market did 10% in a year and you had 1.5 times the exposure to the market, your expected return should have been 1.5 times the return of the market. You should have got 15% for the amount of risk you took, but because you only got 12%, you actually underperformed on a risk-adjusted basis. That's just a super simple example of, of like how a factor regression can actually give you insightful information. It's called explanatory power. And then, of course, today we have these multi-factor models. So this is where I left off in the last video by essentially saying the beta, or the factor loading, is how exposed you are to each factor. And you can decompose the return on an asset or on a fund or on your own portfolio into a set of betas or factor loadings times how well the factor did. So your own return can be decomposed into how exposed you are to value times how well value did, plus how exposed you are to profitability times how well profitability did. It's just a decomposition. And for this video, now I'm going to start adding in a little more information. So it's quite simple. And then again, yeah, there's a good explanatory power. So now we're going to be adding in really just one additional term that matters. We're going to be adding in plus alpha and then plus epsilon. So alpha is known as the intercept, and the alpha is the portion of the return that cannot be explained away by exposure to known risk factors. So some of your return just comes from the value premium, the profitability premium, the momentum premium, all the sort of factor loadings times how well the factor did. You could have just got those anyways. The alpha is what you could not have gotten anyways. The alpha is the unexplained portion of the return. If the alpha is positive, that means that on a risk-adjusted basis, you still outperformed. And of course, if the alpha is negative, that means on a risk-adjusted basis, you still underperformed and destroyed value. The alpha is an extremely important term, and we're going to be using the alpha literally inside of Python. And then just, I guess, for completeness or whatever, you might sometimes, if you're looking at the literature, you might see a term show up called epsilon. That's just like an error term. We really don't need to worry about that too much for now. Yeah, so this is how things look in Python. You would have saw this. This is just the formula we're using. This is just, this is like the sort of generic formula, and this is what we're going to be doing in this video. It's alpha plus the beta of the market, size, value, profitability, investment, and momentum, and then plus epsilon. Cool. So now I'm going to pick two different examples of where doing one of these factor regressions can really, really help us to gain information and actually almost in a way like advise on decision making and help us to make better choices for our portfolios. So this is an example of cap-weighted versus equally weighted index funds. So this has been a debate for quite a while. This is a pretty sort of common reoccurring question. Should I use cap-weighted? Should I use equally weighted? I'm pretty sure it actually started to pick up traction as a common question among index investors, especially recently. So a cap-weighted index fund just means a market cap-weighted index fund. Literally just means the total stock market, ideally the global total stock market, not just within the US, whatever. This is just a regular index fund. This is just the market portfolio. By definition, the total average stock market is cap-weighted by definition. Now, some people recently are sort of pointing out some flaws or pointing out some issues within cap-weighted index funds. The biggest one would be market concentration. We're seeing now, and they're not wrong, by the way, they're correct. We're seeing now a very tiny number of very large companies within the market index are making up massive weights, right? So imagine, for example, if like one single company had the market cap of 50% of the market. Of course, it's not that bad, but that's an example of market concentration. A tiny number of extremely large companies are dominating the weight of the index. And the rationale is that that's going to lead to poor diversification, and also perhaps the valuations are inflated of that tiny number of carrying stocks within the index. And some people are sort of pointing that out and saying, well, why don't we use equally weighted index funds instead of holding every single stock in proportion with market cap weights, why don't we literally just hold every single stock equally, just like a 1 over n type of naive, just equal weight? And it seems like a decent idea because you might have more diversification and it might fix the market concentration issue, and they're actually not wrong. And the crazy thing, I'm actually going to, again, tab out. I might as well just do this in Python again. The crazy thing is that in most markets, over most samples, the equally weighted strategy actually gives you a higher return on average. The backtest actually looks good. It looks like you're actually winning. And there's a decent chance that if you buy equally weighted index funds, you actually will have better returns. But when you do a factor regression on the equally weighted index funds, you can see that the higher return is just a result of being exposed to known risk factors. I believe it has a slightly higher beta. And then, of course, intuitively, since you're tilting away from big-ish, expensive-ish stocks, you're going to be exposed to the size factor, you're going to hold smaller stocks, and you're going to be exposed to the value factor, you're going to hold cheaper stocks. And once you account for that, it essentially takes away that alpha, that overperformance that you're seeing. We'll talk more about that in a second. And then the second example is with dividend funds. This is probably an even more emotionally charged, longer running debate between all these index investors and whatever, where they say, why am I just buying a market cap fund? Why don't I buy this dividend fund or this high dividend fund or dividend appreciation fund or whatnot? People want to earn dividends emotionally. I covered that a little bit in my last video. It really makes no sense at all to have a preference for dividends. Again, if we look at the source of the premium, a company has a bunch of cash flows, and you purchase those cash flows being discounted by some discount rate back to the present. The discount rate is your expected return. These question marks up here represent the company earnings. You're not discounting dividends, you're discounting earnings. It doesn't matter what the company does with their earnings. They can pay down debt, they can invest back into the company. They can book it on their own balance sheet as retained earnings. They can do an acquisition. It doesn't really matter what they do. They don't need to distribute it to you. Again, on a pre-tax basis, you should have no preference for dividends. And on a post-tax basis, you should have a preference against dividends, since you're obviously going to face regular income tax instead of capital gains, and it can't be deferred. I could make a whole video on that. But the same thing happens. If you backtest a dividend strategy and a non-dividend strategy, the dividend strategy actually has better returns. And there's a good chance that if you buy a dividend fund and hold it for 30 years, you probably will outperform. But when you do a factor regression, it turns out that the alpha that the dividend fund is generating can completely be explained away by exposure to profitable stocks and value stocks, right? In general, cheaper stocks and more profitable stocks generally will have like a higher yield and whatnot. So yeah, and I might cover some of this in Python actually. Okay, so this is by no means like a proper analysis. Again, I could do a whole video on this later. I just wanted to, just for the sake, show an example of the factor loadings of the equal weight strategy and then the dividend strategy. Now, ideally, I would actually go and pull index data and go back decades and decades and decades, whatever. Right now, I'm just using Y Finance and I'm just doing some ETFs, and we're just limited within the US for now. It's just to like showcase some concepts. It's not like a proper analysis or anything. But for example, I'm just pulling the ETF SPY, which is just the S&P 500, and then I'm pulling the RSP, which is the equally weighted version of the S&P 500. Now, if we truly did this globally and we truly went back decades, the equally weighted version would have higher expected returns. In this case, just using, again, the arbitrary in-sample data of the ETF. If you know a thing or two about SPY, S&P 500, it's been on a roll. If you know about the actual recent performance of all these giant tech stocks and stuff, it's really hard to beat the S&P 500. So again, this is not like an actual analysis. I'm just capping this at 2022, just so we can see RSP come out ahead. Yeah, I'm data mining, whatever, okay? This is just to showcase some principles. But if you look at the factor loadings for the regular S&P 500, and then for the equally weighted version, we can see it's like a little more volatile, right? A little more exposed to market beta. We can see that it's a little more tilted, or actually quite a lot more tilted toward the size premium, SMB, and we can see that it's quite a lot cheaper. It's tilted more toward the value premium, and in this sample where it actually comes out ahead, it actually has a negative alpha once we account for the fact that it's exposed a little more to market, but mainly more to smaller stocks and value stocks. So that's an example where we can sort of like use factor regressions. Again, this is not the best analysis. This is just to showcase the examples. And then I'm doing the same thing here between, again, SPY, S&P 500, and S&DY. This is just the high dividend stocks within the S&P 500. Again, same deal. The S&P 500 is pretty hard to beat. These are just ETFs. It's not like a 50-year sample. Same deal. But if we look at the factor loadings, we can again see that the dividend stock, that the dividend index is highly tilted toward cheaper stocks and highly tilted toward more profitable stocks, and even tilted towards stocks that have conservative investments. Again, if you have some intuition as to what type of stocks pay dividends, we know that dividend strategies load positively on value and profitability. And then same thing here, we still have a negative alpha. Again, it's still underperformed. Again, it's not ideal. I'm just sort of showing you how you might be able to use these factor regressions. This video is just sort of general knowledge and stuff. I can make videos later where we like fully do actual analysis on stuff. Now, of course, we can take this concept of factor regressions and we can really just do a factor regression on against just about any fund. Now, a lot of people obviously will look at Warren Buffett, and obviously Warren Buffett is known to be a massive supporter of index investing, but they'll look, decades back and they'll look at his track record of active management, and he produced, massive excess returns over the market, clearly. And a lot of people will use that as an argument against market efficiency and in favor of active management. Now, in the Financial Analytics Journal in 2018, we got this brilliant paper called Buffett's Alpha, where they essentially did what I just did on the equal weight fund and stuff. They essentially more or less tried to do factor regressions against Warren Buffett's returns. And then we can see here on page 45, they essentially state that once you control for all of these known risk factors, plus a BAB, which is betting against beta, and QMJ, which is quality minus junk, which is quality, which is essentially AQR's version of profitability. They're different, but they're similar. But once you account for these known risk factors, he still had a slightly positive alpha, but it essentially became statistically insignificant and indistinguishable from zero. So they also had to account for the leverage factor as well, since he was like leveraged. Again, there's a lot of nuance here. But the takeaway is that even Warren Buffett's alpha can actually be explained away from exposure to known risk factors, which you can just take anyways. And then at the end of this video, we're actually going to be talking about efficiency behind harvesting these risk factors, and we're going to get into that stuff later. Now, one of the authors of this paper, it was published by 3 people, I believe. One of the authors, though, Lasse H. Peterson, if I'm saying that right. I believe he's from Norway, actually. But one of those authors, he actually wrote an entire book called Efficiently Inefficient: How Smart Money Invests and How Market Prices Are Determined. And I'm actually reading this book right now. I actually just got it, and I just started reading it. It's almost, in a way, an extension, or almost building on the original Burke and Green research from 2004. In fact, I literally have the book. I like got it, and I just started reading. I didn't read it yet. I just started reading it. But yeah. It essentially builds on the original Burke and Green research from 2004. That's a great paper. That was like a seminal paper. When we talk about market efficiency, I'll definitely make a whole video on this, especially once I'm done reading the book. But essentially, they go into the fact, or into the concept, that there's like 2 layers of market efficiency. I mean, there's actually many different layers of market efficiency, depending on what you're looking at. In fact, what a lot of people say is that markets are micro-efficient but macro-inefficient, where all the stocks within a certain country or market or sector are all priced extremely competitively and extremely well, but then an entire, like, all of emerging markets or all of this sector or all of this certain geography could all be underpriced compared to another one, because maybe there's, constraints on like capital and constraints on who can invest in what, and it might not be the same people or the same institutions or the same dollars doing the pricing in 2 different markets. I mean, there's like so much research, right? But a lot of commenters were asking me on my previous finance videos for like sources and recommendations on how to learn more. I'll probably actually maybe put some like in my description or whatever. I answered a bunch of commenters. Comment your questions, obviously. I'm pretty sure I answered every single commenter on all the other finance videos, hopefully. But one of my best recommendations, I don't have it with me right now, was a book by Andrew Ang. It was called Factor Investing, and then I forgot what the subtitle was called. It was like a 600 or 700 page, extremely dense incredible book, all on factor investing. It's one of the best books I can possibly recommend. There's also a book I recommended to somebody else just called A Random Walk Down Wall Street. That's an intro-level book. It's easy to read. It's an absolute classic. I might actually compile a list maybe in my description or something of sources. Now, there's a podcast and a YouTube channel. I'm assuming a lot of people watching this right now, especially if you made it this far, are familiar with it. There's a podcast called The Rational Reminder Podcast, and there's a YouTube channel called Ben Felix. Ben Felix is one of the people that runs and originally founded The Rational Reminder Podcast. I've literally been watching that podcast since way back in the day. It's a Canadian podcast. I'm actually from Canada. I was like literally one of the first people. I watched the Canadian Couch Potato podcast. I've been studying finance for a while, but I would highly recommend you watch that podcast. They do what I do in a similar way, where they'll like take a research paper or something and go over research. In fact, a lot of the time I would listen to an episode where they introduce a paper, and then I would go and read the paper. And then the other half of the time, I would have already read the paper, and then they would release an episode months or years later on a paper that I read already, and I would be like, no way. I said in my last video, there's a point in my life a couple of years ago, back when I was in like third-year university, or this was actually back when I was in like first-year university 4 years ago or 5 years ago. I just graduated recently from my undergrad. Right now I'm actually in grad school for computer science, though I want to get like a PhD or another master's in like finance or something. I don't know. Oh, I'm just rambling right now. But what was I going to say? Yeah, there's a point in my life where I just read so much finance research. I would wake up and I would read Journal of Finance, Journal of Portfolio Management, Financial Analytics Journal, all this stuff, and a bunch of AQR research. And I would sometimes read one or even two papers before I even went down and ate breakfast. And I would read the paper, and then I would go downstairs and I would like explain the paper to my mom. I would video call Miguel. Shout out Miguel if you're watching, one of my best friends. I would explain the whole paper to him. I would literally just read research, financial research all day. And then something I would do rarely is I would actually read the paper and then reconstruct the results of the paper within Python and see if I can like come to the same conclusion with the same data. I was thinking about doing that on this channel also, where I might just take a paper, explain the paper, and then reconstruct the results of the paper. It's sort of almost in a way similar to what I did last video on onionflation for the Tor stuff on the computer science side. I picked that paper and then almost in a way recreated it or showcased some of it. But yeah, now if you also want to learn about factor stuff, I would recommend classic papers from AQR. They have a series of papers titled Fact, Fiction, and Blank, where the blank is just the factor. So like fact, fiction, and value investing, fact, fiction, and quality investing, fact, fiction, and the size effect. Great papers. Those just like aggregate a bunch of different research. You can just bang those out real quick. Like all my knowledge from finance just comes from like papers. I mean, most of it comes from papers. Rational Reminder Podcast is great too. They like recap papers. I mean, there's like so many good resources. And then there's also like edX and Coursera and stuff, MOOCs. I did a bunch of MOOCs on finance, economics, monetary economics. I'll link to some of this stuff in the description. What else was I going to say? Yeah, I was watching, I think it's actually in my notes. I just have bullet points right now for this video. I think it's in my notes. But later on, I think I bring up a lecture I watched from David Swenson. It's such a strong memory. There's this YouTube channel, there's like MOOCs, like Massively Online Open Courses. There's a YouTube channel called like Yale OpenCourseWare or whatever. Most universities have it. And they just have lectures. They had guest lectures from David Swenson, Robert Schiller, just all these people just talk, and you can just listen to it just for free on YouTube. And you can just learn like so much, Right now I'm like working a job full time. So the time spent like learning stuff went down massively, which is highly unfortunate. If it was up to me, honestly, I would just do YouTube full time and just learn full time and just make videos every single day. Anyways, whatever. Let's get back to it. Oh yeah, so where I left off, that was just like a tangent. Where I left off with the Burke and Green research and with that book called Efficiently Inefficient is there's essentially, they say there's like two layers of market efficiency. There's like the regular layer that exists on the underlying level of like stocks. And when we normally say market efficiency, that's the layer we're referring to, where, if Apple makes a bunch of iPhones and they're expected to have this much profit, all the other market participants read their earnings statement and do their research, and all this information is public, and they price it into the price. If somebody thinks a stock is underpriced, they'll buy it, it'll bid the price up a little bit. If somebody thinks a stock is overpriced, they might sell it or short it, bid the price down a little bit. That's like regular market efficiency, is stocks. All publicly available information is incorporated into the stock price. I actually talk more about that later in the video. But what the Burke and Green research does, and what this book talks about, is a second layer on top of that layer on the fund level or the asset allocator level, where let's say there's a highly skilled manager. Think maybe like Peter Lynch, for example. There's a highly skilled manager that's actually producing an alpha, a real alpha that can't be explained by factor regressions. They're really good at buying stocks. That's rare, but it's possible. And it does and will happen. Now, can you identify it ex ante, blah, 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 whatever. We can talk about that later. But if that happens, and if people actually do identify it, everybody's going to start shoveling their money into the skilled manager to chase their returns, which makes sense. That's what's supposed to happen. Now, the key concept is that capacity is the enemy of an alpha, if that makes sense. The more money there is chasing either like a literal factor premium or an actual alpha from a skilled manager, the more capacity, the more money that goes into that fund, it's going to diminish the amount of alpha that manager can produce. And it makes sense if you think about it logically. Let's just pretend that there's a stock on the stock market that for some reason is a diamond in the rough. Let's say there's some biotech company that got FDA approval and they made the next best miracle drug, and for some reason everybody just like forgot about it, right? We're just doing a hypothetical example. So let's say that this company is actually underpriced and markets are inefficient, nobody caught up on it. If there's a random guy that has like $1,000 of capital and he knows this fact, he's going to put his whole $1,000, his whole net worth of $1,000 into the stock, and hopefully he'll earn good returns later on. But just putting $1,000 into that stock isn't actually going to bid the price up to some insane value, right? But if an institutional investor now puts $100 million into that stock, it might actually be enough to fully arbitrage away the mispricing and bring the price up. That's sort of at a high level how these things work. It works on the individual stock level. It also works on the factor level. Like in theory, it's a little different on the factor level, but like in theory, value, momentum, profitability, these factors in and of themselves also have capacity constraints. Although because it's risk-based and stuff, again, we can talk about that later because it's more nuanced, it's not as clear-cut, but it also exists on the fund level. If everybody gives Peter Lynch their money, if he gets enough money in the fund, he's not going to be able to generate an alpha anymore. It's going to drop down in magnitude until eventually it's completely arbitraged away. And the cool thing is that actually makes markets more efficient. Like if there's a true manager generating alpha, he's going to get a bunch of money. And there was a bunch of research done on this. And essentially the result is it reduces, like the investor investing in the fund is going to be able to generate less alpha for themselves. If you get in really early, you might get a little bit. Eventually it should come down to zero, but then the amount of revenue that the fund company and the fund manager generates, like the actual true economic rents accrue to the manager, not to the investor, which is also in line with like economic theory and stuff. It's actually just like insanely cool, right? There's so much research, and this is kind of what I'm going over right now. And I actually have an example of this on my next slide. Again, if you're a Ben Felix viewer, you would have saw that Ben Felix made a video on this many, many years ago, like 6 years ago. But there's a company, a fund company called Renaissance Technologies. Most of the time it's called Rentech. And they have a fund called the Medallion Fund. And these guys are like quants. These guys are like the smartest people ever, whatever. I'm like simplifying a bit, right? But they have an incredible fund that produced, I think, like 66% per year, like literally 66% a year, gross though, and then it was like 39% or something a year net, which is still incredible over the whole track record of the fund. And they literally needed to cap capacity of this fund, and I think it was like 10 billion. I have a bullet point for they had to cap capacity of this fund at $10 billion, and they actually distribute the earnings, they distribute the profits to the investors of this fund every single year. You can't even compound at 39% a year. You just need to sit and earn that every year, and they just give you your money. They don't even want your money. That's another example of, sort of capacity constraints. So this book is essentially talking about flows go to managers that are truly skilled and truly able to generate alpha, which in turn arbitrages away the opportunity to find skilled managers, since if you find a skilled manager, his alpha is going to go away. Anyways, I know I'm just rambling, but it's really cool and really fascinating. And, like just reading research and stuff, like it's just like incredible. Anyways, yeah, so that's that topic. Okay, so that was the second tangent there. I mean, what do you want me to say? It's like so interesting, right? So moving on. So let's take a look here. So yeah. So as I said, factor models, again, you do factor regression. You can just decompose returns into how exposed you are to each factor. And then, as I said, multi-factor models are incredibly powerful. Current day multi-factor models can explain away 95% of the differences in returns between two diversified portfolios. Essentially what that means, more or less, is that factor regressions basically proved that active management is really just various forms of factor exposure, right? If you go to an active manager and they build this portfolio for you, you're essentially just paying them to deliver factor exposure to you in a much more opaque and expensive and inefficient way. And I'm going to be telling you why it's more inefficient later, because you might be saying, okay, like, does this actually make passive or active better than one another? Like, why don't I just do my active management within small cap value, right? And I'll be talking about that in just a second. Yeah, so with all this being said, hopefully you now sort of understand what factors are, but what's the sort of actionable thing to do about it? Let me see. Yeah. So as I said in my last video, I personally am a factor investor. And a factor investor, you're essentially halfway in between active and passive. And what this sort of whole factor investing revolution or whatever, once all this research has sort of been coming out, factor investing used to literally not exist before all these asset pricing models were published. In fact, even passive investing literally also used to not exist either. In fact, passive investing is factor investing, but just in a single factor, just the ERP, right? When I say factor investing, what I really mean is multi-factor investing. But essentially, this whole factor revolution stuff led to the indicization of a portion of active management, where essentially a portion of active management, instead of being traditional active management, is now like a set of like quantitative characteristics for harvesting these factors. And I'm gonna sort of, take a step back here in just a second. But this is the kicker. So believe it or not, you are already a factor investor. I know I'm a factor investor because I explicitly chose to be a factor investor, but if you're buying actively managed funds, or you're managing your own portfolio personally, or you are using a private portfolio manager, you're already a factor investor because the returns, and even more importantly, the risk of your own portfolio are already dominated by a tiny number of known risk factors, the same way mine is. Right? This is true regardless of whether you're using mutual funds, ETFs, private manager, right? You're still getting the risk and return of these factors. There's no escaping it, right? That's like saying, because I don't track my calories and my macros, the pizza doesn't have calories in it. That's the sort of point I'm trying to make. No matter what, you're still affected by this. You just maybe aren't capturing it in the most perfect way. The only exception would be if you're a stock picker that's picking a very minimal number of stocks, right? If your portfolio literally consists of one stock or two stocks or five stocks, then your portfolio risk and return is going to be dominated by idiosyncratic risk, which is stock-specific risk. You got to get up at least to 30 stocks, 40 stocks. That's why we say explains the differences in returns between two diversified portfolios. If you have a 3-stock portfolio, then you're just completely dominated by idiosyncratic risk. In that case, you technically would not be a factor investor, but to everybody else, again, you're already a factor investor. So now let's sort of highlight the differences between being an explicit factor investor like me and potentially using active management, sort of getting this opaque, potentially time-varying factor exposure. Okay, so I said I would take a step back and kind of have a higher level overview. So let me bring up this just absolutely seminal 1991 paper by Bill Sharp called The Arithmetic of Active Management. I referenced this paper a little before, but I didn't actually explain anything about it. Again, if you study finance or whatever, you're obviously aware of this. But I'll just give you the premise. So let me just real quick define active and passive, right? Because it's really difficult to define. In general, we'll just say active is, a manager picking stocks based on any number of metrics, fundamental analysis, technical analysis. It doesn't really matter. The passive one is the one that's sort of harder to define. How I would define it, just for the sake of we just need a working definition to move forward and make progress, I would say passive is just a total market index fund. Some people will call the S&P 500 a passive vehicle, which I personally think is ridiculous. Because first of all, you're picking one single geography. You're only picking the United States and ignoring every other country on Earth, which kind of doesn't make any sense. Like, I mean, if you think of harvesting the ERP as the equity risk premium on the market portfolio, why would you only harvest the ERP of a single country? That's already not the greatest idea, in my opinion. And then second of all, with the S&P 500, you're only targeting large cap stocks. So you're actually, ignoring the small caps, which is, on average, eventually, potentially, maybe going to be a drag on returns, though we'd have to get into it later. So you're only targeting large cap stocks and mid cap stocks within the US. And then on top of that, the S&P 500 is a committee-based index. There's an implicit built-in, I think it's like they need to have 2 trailing quarters of earnings or something like that. So there's like a little bit of an implicit profitability screen, but it's committee based. At the end of the day, it's a group of human beings get together like every quarter or whatever their reconstitution date is, and they decide which 500 stocks they're picking. And it's like, why on earth would you call that passive? That the S&P 500 is not the market portfolio at all. So how I would define passive is we're just going to say, like the ETF version, the closest you can come would be the ticker VT, not VTI, but VT, just total global stock market, essentially every stock in the world held in market cap weights. Now, how the fund actually tracks that, how often are they reconstituting? We can talk more about this later, but we'll just call that market portfolio as being passive. And then active is essentially anything that just deviates from that. Even the S&P 500 is active. You're taking a size bet, a geography bet, and doing this committee stuff, and it can be front run. We're actually going to talk about that in a second. Anyways, whatever. So that was a digression. So when we look at this paper here, The Arithmetic of Active Management by Bill Sharp, there's two lemmas, or 2 propositions that I highlighted, and this is all we need to understand for now. So the first one is before costs, the return on the average actively managed dollar is going to equal the return on the average passively managed dollar. And this makes sense if you think about it, right? The average index fund investor is going to earn the average return on the market. That makes sense. And on the flip side, the average actively managed dollar, or the average active investor, is still going to earn the average return on the market. That's just how averages work. We're talking about on average. And before costs here means like no costs, no MERs, no spreads, no fees, no commissions, right? That just makes sense. That's how averages work. Hopefully we can all understand that. The second part now is that after costs, now we're going to take into account spreads, commissions, trading costs, MERs, whatever. After costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. And this is sort of like the key to understand with this paper, right? On average, everybody earns the average return regardless of what your investment style is, right? But then, if an index fund investor pays, let's say, 10 basis points a year, they're going to earn the return on, the average index fund investor is going to earn the average return on the market for that year minus 10 basis points, right? 0.1% less. It's pretty close to the average. But then the average active investor, let's just say, I'm not looking at the data, let's just say that the average actively managed mutual fund, or whatever it is, right? Let's just say that the average active fund has a management fee, let's just say of like 2.5%. That means that on average, the average, right, like literally how averages work, on average, the average active investor is going to earn the return on the market minus 2.5%. That literally, mathematically, by definition means that the average passive investor will do better after costs than the average active investor. This is like literally just the premise of this paper, and it really makes sense if you think about it. Now, in recent years, some other authors and researchers have come out with some other papers that kind of like challenge this premise, and there's definitely merits to it. And again, like it's more simple than this, but for all intents and purposes, for now, for this video, we can just think of this as being true, and this is definitely not that far off from the truth, regardless of what your opinion is, right? We can stick with this for now, and let's move on. So I'm just looking at my bullet points right now. That's where I was going to mention that that guest lecture I watched on YouTube from Yale, from David Swenson. I'll put it up right now on the screen or whatever. I don't have it prepared. But he was just sort of explaining how this works. It was just one of my fondest memories. But everybody should understand the mechanics of this. So essentially, the thing to understand is that the market is a zero-sum game. But instead of being a zero-sum game truly centered around zero, it's a zero-sum game centered around the market average. So it's not exactly a zero-sum game. It's a game, right? You can just think of it as being a zero-sum game centered around the market mean, the market average return. So what that means is that for an investor to earn a 1% excess return over the market, another investor, another market participant mathematically has to underperform the market by 1%, right? If one investor decides to overweight a certain stock, let's say Apple, another market participant mathematically, by definition, needs to underweight Apple. Nobody's arguing that. That's just the truth. If somebody overweights a stock, somebody underweights a stock. If somebody generates a positive alpha, somebody generates a positive alpha. For you to earn an alpha, for you to win, for you to get an excess return, somebody else has to lose. That's simply just how averages work. That's kind of just a foundational level thought that you probably knew already, but it's just good to say explicitly. And then how that ties into the concept of the rationale behind index investing and market efficiency is that if these market prices are truly efficient and they truly follow random stochastic walks and there's no autocorrelation, and of course, true market efficiency, it's not a binary, are they efficient, yes or no, it's a spectrum, and markets really, mechanically, can only approach being completely efficient. Literally, mechanically, like by definition, it ties into that book I was talking about too. If markets were completely efficient all of the time, who's making them efficient in the first place? You need active traders to literally do the trading in the first place, to incorporate the prices or to incorporate the information into the prices in the first place. So some marginal investors must be getting rewarded at least a little bit for arbitraging away mispricings to make markets efficient, same as how the earliest investors to, let's say, identify Peter Lynch, and I'm not even looking at the date, I'm just using Peter Lynch as an example, the earliest investors that can identify a skilled active manager actually might earn some alpha for a limited period of time, eventually be arbitraged away. The people that arbitrage away mispricings make the markets efficient and are rewarded with an alpha for doing that, right? But if we just assume that markets are efficient, and in my opinion, they are probably extremely efficient, if we assume markets are efficient and you can't predict asset prices because all information is already incorporated into an asset price, right? When we pair this concept of on average, the average index investor does better than the average active investor, and then we pair that with the fact of there's no way to reliably perform above average. There's no way to be the active investor that wins. You are on average just going to end up being average because asset prices are random walks and unless you have a true information asymmetry, but that's probably not going to happen, right? At least personally, but it's not about, like some people say, well, I'm not that smart, I'm going to go to a manager that's smart. It's not about if your manager is smart. It's about, is your manager smarter than all the other smart managers? Does one manager actually have a true information asymmetry? The stock market is something we call a complex adaptive system. I draw analogies to my friends with like shopping lanes or lanes on the highway. Like if one lane is moving faster on the highway, a bunch of other cars are going to recognize that and move over to the faster lane and eventually be held in equilibrium. We can talk sort of more about this later. I talked about this a little bit. I did a betting market analogy in my market efficiency video. Anyways, so when you pair the fact that the average investor earns the average return minus the fees, and it's cheaper to do index investing than average investing, and you will just be average because there's no reliable way to actually be the winning active investor. You pair these two ideas together, and that's the rationale behind index investing, is let's just settle for the average return and minimize our costs and be an index investor. And that's if you're a boglehead or a couch potato, and that's cool. Now, we can talk about luck and skill, right? There's this seminal paper, again, published by Pham and French, called Luck versus Skill in the Cross-Section of Mutual Fund Returns. This was, what does that say there, 2010? I thought that was earlier than 2010. Who knows? And then there was this paper published by Mark Carhart. I talked about the Carhart four-factor model. Mark Carhart is the same Carhart, published. This was called On Persistence in Mutual Fund Performance. These are just some interesting quotes to just highlight that, I remember how he said factor models explain like 95%, and I was like, is the remaining 5% luck or skill? For most people and most managers, it's probably luck. Anyways, these are just some of my favorite quotes. There's a quote here that says that bootstrap simulations suggest that a few funds produce benchmark adjusted expected returns sufficient to cover the costs. And then this one says that the results do not support the existence of skilled or informed mutual fund portfolio managers. You know, if you sort of look at the market efficiency and look at the data, there's probably no real way for you to gain access to a fund that can be above the average. So I don't know. Hopefully that sort of makes sense. Oh yeah, I had a third quote here from the 2016 shareholder letter from Berkshire Hathaway's. I'm not going to read this whole thing out, but essentially Warren Buffett was just saying the exact same thing that Bill Sharp said, that the average investor does average. So if you're active with higher costs, you're going to on average perform worse. So all of this makes sense. But here's another extremely important thing. I have been talking for so long. So I'm building up to this idea. I told you maybe 20 or 30 minutes ago, everybody's a factor investor. You're a factor investor too. But if you're an explicit multi-factor investor like me, you're probably going to have more efficient exposure to these premiums. And it's like, what does efficient mean exactly? I'm kind of building up to this. So here's the kicker. So you understand everything I just said. We're going to introduce now the fact that markets have immense skewness. So this just represents now every single stock. So pretend every image here, pretend there's 8,000 images for 8,000 stocks in the world, okay? This is just my visual depiction. There's immense skewness in stock returns. So when you look at the average stock return, like how people say the S&P 500 returns like 10% a year or whatever, obviously expected returns will be much lower than that going forward, or the ERP, whatever, 5% a year, 7% a year, whatever number you come up with, right? The number for the average return on the market consists, obviously, of a weighted mean, a weighted average of all 8,000 underlying stocks. And when you actually look at the 8,000 underlying stocks, you see something like this. The vast majority of the stocks provide pretty terrible returns. They honestly, like, we can look at the data later. There's a bunch of really good papers. I'm not looking at the actual data and the numbers. I'm just like going off my mind right now. But the vast majority of stocks, or a very, very large number of stocks, are going to struggle to even beat T-bills. A large chunk of them are even going to provide negative returns. And then a very tiny number of stocks, a very, very tiny number of stocks, are going to provide massive returns. And when you take this massive weighted average, you still harvest the ERP every year and you still earn your returns, right? And that's fine. But if you, let's say, instead of buying this total market index fund, let's just say, in theory, for some weird reason, you buy 90% of the market. Like, let's say for some reason, instead of buying 8,000 stocks, you buy 7.5 thousand stocks. Like, if for some weird reason you just take 90% of the market, if you happen to miss out on, like, the best 5% of stocks or the best 10% of stocks, you're not just going to earn the market average. You're going to perform so terribly, you might not even beat T-bills. This is because of the skewness that's present. If every single stock provided the same average return, you could take 50% of the market, you could take 20% of the market, they'd all give the same average. If, I'm just saying if in theory they all provided the same return. But the skewness is so immense that even just taking 90% of the stocks and excluding 10% of the winners, you might not even beat T-bills. You might have like a negative premium. So that's why, that's essentially one of the reasons, one of the premises behind the famous Jack Bogle quote, where he said, don't search for the needle in the haystack, buy the whole haystack. Everybody knows that quote. Hopefully everybody watching this knows that quote. It's like the most classic index fund quote. And if you don't look at the skewness, it still kind of makes sense just because of get the average return with less fees. But the real reason why is because of this. If you buy 90% of the haystack and you miss the needle in the haystack, you're going to perform terribly. So that's why there's like such a focus on broad market, total market index investing. You don't want to capture everything on this slide and leave out one of the winners. You ideally want the biggest coverage possible to capture everything. So this is where that concept of like efficiently capturing factors come into play, because you might ask the question, I understand what factors are, but maybe I believe in factors, but maybe I don't believe in market efficiency. And there's some interesting stuff that says, like, when you test an asset pricing model, you're testing market efficiency jointly with how good the asset pricing model is. And we could talk more about this later. But you might say, like, I get that small cap value stocks have a risk premium. Why don't I just pick an active manager within small cap value? Well, the reason why is kind of this, right? If we go back to the last slide, or if we go back a couple of slides ago, and if we just assume that in this world, there's no fees, there's no spreads, there's no market makers, active managers work for free, and there's truly zero costs. If we look at, if we pretend this is the world, then it shouldn't actually matter on average if you're an active investor or a passive investor, right? On average. But because of the skewness, even if there's no fees, right? If let's say there's 10 active investors and 10 passive investors. All 10 passive investors buy the whole market. They're all going to get, let's say, 7% a year. But if there's 10 active investors that all take, right, because active investors can't buy the whole market, literally by definition. I mean, unless they weight it differently, but there's obviously not going to be 8,000 stocks in an active fund normally under normal circumstances. So if there's 10 active investors and they all pick one stock or two stocks or three stocks in this example, even if it's a couple hundred, because of the skewness, the kicker is that one active investor is going to get insanely good returns and that 9 active investors are going to get way below average returns. On average, they perform the same, but you introduce so much skewness when you don't capture the whole thing, right, that even if there's no fees, you should still be a passive investor. This is going to lead to volatility. This is going to lead to sequence of return risk. This is essentially going to mimic a lottery-like distribution. That's how lotteries work. In fact, lotteries have, negative expected returns for like a massive skewness, massive kurtosis, whatever. That's sort of the thing that happens. So you want to essentially make your outcome as statistically reliable as possible. In this example that I'm giving is just within the market as a whole, but the same thing exists within value, within profitability, within momentum, right? You don't just want to take this subset of value stocks or the subset of value profitability small cap stocks, because then you're going to have the skewness, and that's if there's no cost, right? You're going to have a less reliable return, and it's going to cost you more. And of course, it might also be time varying depending on what you're doing. If you can, essentially what you want to do, the analogy I like to use is like shrink wrap. You want to decide, step one is decide what factors you think are real, how much exposure you want, blah, blah, blah. And then once you're like, okay, I want these exposures, you almost want to shrink wrap your portfolio around only the factors. You want to extract with precision just value, just momentum. You don't want value plus all this weird skewness because you're not fully capturing value, and then you're going to miss out on the best performing value stocks, and then your manager is going to give you some idiosyncratic manager risk. You want to shrink wrap it down to extracting just the premiums. That's what I mean by efficient exposure, if that makes sense. So I'm editing the video right now, and I just wanted to interject real quick, since I realized that what I'm saying might sound a little ambiguous, so I just wanted to clear it up. So let's say that your fund, or you, or whoever that wants to target a factor, right? You go to the market, and the first step is you just do a sort on whatever factor you want to target. So this could be value, profitability, momentum, quality, it doesn't matter. Let's just say value. So you do your value sort, and you get a value signal. And you have all of the low value stocks on one end and all of the high value stocks on the other end. And then if you want to capture value, let's just say you grab the top 3 deciles of value. This is just how you would normally target value, let's say, just by definition. What I'm not calling bad, and what I'm not saying is going to destroy your statistical reliability, right? What I'm not calling bad would be this. So let's say instead of grabbing the top 3 deciles of value, you grab the top singular decile of value. This is something that we refer to as concentration. Yes, you're going to have less stocks in your portfolio, but this is not what I'm calling bad. This is not what I mean by casting as wide of a net as possible. This would still be completely okay, sort of just in my opinion, in the context of what I'm talking about. Now, this does mean you're going to have less stocks, and it does mean that you're also going to have a higher beta on value. It means you're going to have a higher value loading. So you might have a value loading of 0.6, whereas in this case, it might be 0.4. That means you are going to have higher expected returns, but you're also going to have more volatility and more risk as well. Now, technically, maybe it's a better approach to grab the top 3 deciles and then lever up until you reach the expected return or the loading of the top singular decile. That's a completely different question. That's fully out of scope. I'm just sort of going over the things here. But what I'm saying is if you do, a tinier sort of subset within this quantitative, monotonic sort, this is okay. Just to be clear, what I'm calling the, quote, bad thing, the thing that you want to avoid, would be this. This would be, a very tiny, actively managed sliver within whatever universe you're talking about. So this would be, if you grab, an active manager that manages within value stocks or within small cap stocks, this is what I'm saying is not casting as wide of a net as possible. This is what will sort of lead to a worse statistical reliability of returns. If it's a tiny little sliver and it doesn't follow this monotonic sort, and it's sort of like random sort of qualitative stocks cherry-picked from within the sort, this is what I'm sort of calling like the quote bad thing. I just sort of wanted to clarify that. So just to recap, just so we're on the same page, when I say efficient exposure, I mean you lower your costs as much as possible by taking an index-like approach, and then you also increase the statistical reliability of your returns by casting as broad of a net as possible and having your own personal returns match the returns of the factor to avoid all this skewness and sequence risk. So this is how I view the world personally. This is like literally my sort of worldview, and then I'm going to be explaining where my personal investment strategy slots in. So again, active and passive, as we said, it's hard to even define at all, but we came up with some working definitions where passive is just a total market index fund, not taking bets and deviations based off geography and market cap and committee filters. It's literally just like every single listed stock in the world. That's pretty much as close to passive as you're going to get. And active and passive to me exists on a spectrum. It's not a binary state. So the total market index fund is fully on the passive end. Fully on the active end, it's, again, also hard to define active, but really anything that deviates from this is active. We'll talk about what's in the middle in a second, but the traditional active is you're paying 2% plus a year for actual humans, actual managers to sit down at a table. Maybe they're doing technical analysis. Probably fundamental analysis. They're looking at earnings statements. They're going through data. And they're essentially just making decisions on what stocks to buy. That's kind of just like traditional active and then traditional passive. And these exist on a spectrum. And then something like the S&P 500 would probably exist right around here. It would be extremely close to passive. It's way closer to passive than it is to active. You're still gonna, you can backtest, VT or even VTI versus SPY. They're gonna be extremely similar anyways, right? So that's that. And now let's talk about the factor stuff. So I said that factor investing is kind of like a hybrid in between active and passive. So the version 1 kind of most basic form of factor investing, and we're just going to use small cap value just as an example of the factor. The same thing applies to momentum and profitability and whatever else. And, we talked a little bit about, are you going to target these factors separately or jointly? I talked about that a little in my last video. We can talk about it more later. We're not worrying about that for now. I'm just explaining this worldview. So halfway, let's say, in between passive and active is going to be traditional sort of factor investing. And for this, it's very similar to index investing. Except instead of having your investment track the overall stock market, you're just going to pick an investment vehicle that tracks an index, where the index is just the index for a factor. So there are literally, MSCI and S&P and, all the index providers literally have an index for small caps and value and momentum and profitability and maybe low vol, right? There's literally indexes the same way you can buy a United States index fund or a sector-specific fund, a tech-only fund, or a energy-only fund, right? The same way there's all those indexes. There's literally an index for small cap value. This is just an example of an ETF called IJS, which literally just tracks the S&P small cap 600 value. So this would give you pretty good exposure to small cap value factor. This is sort of like the traditional route to take. It's almost like the index fund version of factor investing. In fact, as I said, index investing is already factor investing. This is almost like as vanilla as you get. This is like as plain as you get. And it's not a bad strategy, but the issue is that it suffers the same consequences that indexing suffers. So let's talk about what some of these consequences are that index funds and factor funds that also track indexes, really just any vehicle that tracks an index, suffers from. So one of those things is that they're susceptible to being front run. And this is just one of the things. I might mention a couple other ones later. But how these funds work is they're essentially contractually obligated to track this index. The manager has no say in what they buy or what they not buy, or even when they trade. They have to track this index, and there's going to be generally a quarterly, it could be semi-annually, there's going to be some period of time, some time interval, there's going to be a reconstitution date and a rebalancing date. And when the index, when the S&P run by Standard & Poor's, not by iShares, when the index provider makes an update to their index and it reconstitutes the index, some period of time after that, or it might be on the same day, right, whenever these dates line up, the fund is going to be contractually obligated to do their trading to rebalance. So let's say that this index, or even the total stock market index, or the S&P 500 index, it applies to all of them. If the index adds a stock to the index, the fund from iShares or Vanguard or State Street is contractually obligated on one day to go to the market and buy all the shares they need to fill up whatever requirement there is in their fund, however big the fund is and whatever the market cap is. They're going to need to buy all the shares of that stock in one day. And there's two things that go on here. First of all, they are massive demanders of liquidity. In fact, I was actually maybe even going to make a video later on. Some viewers maybe might know that one of my first projects ever in my life, programming-wise and finance-wise, was a website called norbertsgambit.net, and it's still live today. And last I checked, I have something like $4 million of people's trades, real, actual people's trades, logged on the website. You don't deposit money. It makes me no money at all. It's just a cost calculator. It's literally like Wolfram Alpha or like Desmos. It's like that, but for a very specific financial technique people do. And I can talk all about that later. But when I started doing Norbert's Gambit myself in real life, I would go on Google and search up Norbert's Gambit calculator, and there were a couple different ones from a couple different people. I think one was a website, one was a spreadsheet. And then when I started learning monetary economics and how markets are actually made with the market makers and suppliers and demanders of liquidity, I realized that there was an issue with all the calculators. There were actually three issues. You can actually open up my GitHub and look at the README, and I listed there was like FX drift, not accounting for supplying or demanding liquidity. There were all these sort of issues. And then I paired together my financial knowledge and my monetary economics knowledge and my computer science knowledge, and I wrote this. I wrote like the code for Norbert's Gambit, and then I made it into a web app, and then I hosted the web app, and it still is live to this day, and it went through many updates, and it actually has like hundreds of users. In fact, that would actually be crazy if anybody here is like, because I posted it in a couple, it's only Canadian, but like if anybody here actually uses that website, that would actually be like insane. Anyways, I'm losing my train of thought. What was I saying? Yeah, so I learned about supplying liquidity, demanding liquidity. We don't need to worry about it too much in this video, but if you go onto a market and you demand a bunch of liquidity in one day, first of all, the sheer volume might bid up the prices and you're going to get worse prices. Second of all, you're going to be, paying the spread implicitly to market makers. And this is going to cost you, and it's going to lead to worse returns. That's one of the issues. And then the second issue is that when Standard & Poor's announces a certain stock is going to be added or removed from the index, individual investors can go in the stock market and they can all buy or they can all short or do whatever they need to do. Let's say Standard & Poor's adds a stock to the fund. Investors can now go in between the time that it's added to the index and when the fund rebalances, and they can essentially buy the stock before the fund is contractually obligated to buy a massive volume of the stock. So the price will not only be bid up by iShares, but it will be bid up before iShares even does any trading. And even if there was some sort of time alignment, investors can still try and get even further ahead by almost in a way trying to like front run the index itself instead of the security tracking the index. Like, for example, an investor can look at the stocks and then think which stock is S&P or MSCI or whatnot going to add to their index and buy it before they even add it to the index, let alone before the actual fund tracking the index buys it. Now, maybe I'm making this sound like a bigger issue than it is. It is an actual mechanical issue, but the magnitude of the issue is not that big. It is a drag on returns, and it would be better to avoid it. But it's not going to completely damage you. It's not going to, remove half of your ERP or anything. Buying one of these index ETFs or index funds is still completely okay. It's just something to be aware of. So the whole front run thing, in liquidity demanding thing, that's just kind of like one issue. Now, not every single fund is going to be contractually obligated to trade on one day. Different funds have different leeway periods. It will still be this fixed thing that they don't have flexibility over. There might be multiple different days where they can do trading or a period of time. We're not getting into the super specifics. The issue might be diminished. It still exists. Now, that's, that whole thing is sort of one issue. Let's talk about another potential issue that these index funds and index ETFs have. So I'm just looking at IJS from iShares. Again, I'm just using this as the example. There's nothing special about it. You can look at any other factor tracking index product, if that makes sense. But if you look at the investment objective, right, or we can also open up the prospectus. I read the prospectuses for all the funds I buy. It will be in here as well, right? If you look at the actual objective of the fund, the objective of the fund isn't to make you money. It's not to provide efficient exposure to the factor. It's not to implement the financial science into a product, right? The investment objective is literally just to track the index. There are ways to earn better returns and decrease costs that are known and available that these funds simply don't take advantage of, because the point of the fund isn't to give you the most efficient, highest return exposure within the value, blah, blah, blah. That's not the point of the fund. The point of the fund is just to track the S&P index. And the S&P index is just trying to get a general handle on how small cap value is doing. I know this almost sounds like in contradiction to what I was saying a few minutes ago, but bear with me. So let me introduce now where I fall on the spectrum personally. And there's no official name for this or anything. This is just in my own personal worldview. So I'm just going to be calling this quantitative factor fund, just like quant factor fund. So let me explain what I mean by this. And I'm just putting, again, these are just examples of random funds. This isn't advice. These are just isolated ETF examples. But an example of what would fall into this category that I fall into, just as the example, would be, for example, ETFs issued by DFA, which is Dimensional Fund Advisors, and also by Avantis. Avantis was actually founded by ex-Dimensional employees. They actually do most things incredibly similarly. And of course, if you're coming from the Ben Felix Irrational Reminder community, you probably know all about these ETFs, as do I. So let me explain what this sort of category is. So it's more active than these regular index funds that, whether or not it tracks a total market index or an index for a factor, it's more active than these funds, but it's way less active than traditional qualitative active management, where people are sitting down and going through earnings statements and earnings calls. And, obviously there's a million different ways to be active. We're not even really looking into the box of traditional active. It doesn't really matter for this video, but it's way less active than traditional active, but it's more active than these sort of index funds. These index funds, of course, are contractually obligated to track an index. That's their investment objective. The index, of course, in this case, S&P small cap 600 value, that index is provided by S&P, Standard & Poor's. There's something called the index provider. In this case, it's S&P. There's also MSCI, Morgan Stanley Capital International, right? There's FTSE, there's Russell, right? There's a good chunk of index providers. Those are third parties. And then the actual fund, being iShares, Vanguard, State Street, whatever else, they go in and they track the index, and they're literally not even allowed to deviate from the index. The goal is to track the index. That's the purpose of the fund. The purpose isn't to make you money. The purpose isn't to implement the financial science, right? The purpose is literally just to track the funds, preferably still with low costs. Anyways, these quant factor funds now are defined as active funds. They do not track an index. They're not an index fund. They are on paper active funds, but they're much more similar to one of these funds than to a traditional active fund. Even though on paper they're defined like an active fund, you obviously need to open up the hood, look at what's actually going on, and you'll essentially find that, this category called quant factor fund that I just made up is a lot more similar to index funds that track an index for a factor. It's almost the same thing, except because they're defined as active funds, legally, it removes the contractual obligations and constraints that burden these factor index funds. So again, these ETFs that I'm picking, it's really the same thing for all of their fund offerings. It's just an example. But now we're just looking at AVUV from Avantis. And if you scroll down here, and I can open up the actual prospectus or whatever, but if you scroll down here, we're going to see that this is not an actual index fund. This specifically is like small cap value and profitability jointly. And we can talk more about this later. I'm going to talk actually more about this in a second. But if you read what this actually is, it says it's small cap, with lower valuations, which is value, and higher profitability ratios, which is profitability. I talked about the actual mechanics in my market efficiency video at the end through the lens of a discounted cash flow, so you can watch that if you're interested in what that means mechanically. But if you read this, we're going to say that it pursues the benefits associated with indexing, but with the ability to add value by making market decisions, blah, blah, blah. And I'm going to talk about what those sort of added things are. And then we can see that, it's not saying we want to track the Russell 2000. It's saying we want an efficient thing, blah, blah, blah. It still says that there's a benchmark, but it's not tracking the benchmark. That's just the investable universe, and then it does its own proprietary strategy inside of it. Now, I'm starting to realize that literally sharing my screen and reading bullet points from the website of the fund provider literally sounds like a sales pitch. This is not advice to buy the fund. I am not affiliated with Avantis or DFA or anybody in any capacity, and this really isn't a sales pitch. It's just that from my years of research, I just happen to find asset managers and products that align with the financial science. That's really like all there is to it, you know what I mean? Now, just to be clear, the takeaway from this video really has nothing to do with DFA or Avantis or this special category. This is just some additional insight from me. This is not advice. This is nothing like that at all. In fact, whether you go with this category or this category, they're really, really, really similar. In fact, the sort of point of this video is the merits of multi-factor investing, and both of these two middle strategies, both are falling into the category of multi-factor investing. I'm just sort of going under a microscope here and talking about some differences. It's really not that big of a deal at all. And in fact, even ETFs as a whole are just one specific investment vehicle, though they're not a bad investment vehicle. I was thinking about making a video later on like ETF mechanics, with like APs, like authorized participants and creation redemption baskets, the way ETFs work, on how they, keep the NAV. I mean, whatever. We can talk about this later, but the actual underlying mechanics of ETFs are actually really cool. But, this isn't related to, I don't know what I'm trying to say. Like, this is just like a tiny, almost like a side. It's not like the whole kicker of the video. There's many different ways to do these factor strategies. You can also do something called direct indexing. Now you need a lot of capital and a lot of trading infrastructure. You don't even need an ETF. You don't even need a fund manager. You could be your own fund manager in theory. Not that you should do that. I'm just sort of, whatever. I'm just trying to give like a holistic overview, I guess. But let's talk about what some of the advantages of having these sort of factor-based, quantitative, technically on paper active funds are. So one of the advantages is that they're not contractually obligated to trade all in one day or all within some time frame, and they're not contractually obligated to track an index. These don't track an index at all. These use their own in-house methodology to calculate what's value, what's small cap, what's whatever. So they're essentially not really susceptible to being front ran, since only they know when they're going to trade. That's one of the benefits. Another benefits is that they have the option of doing daily trading. These funds are only going to reconstitute maybe like once a quarter most of the time. Sometimes it might be semi-annually. These funds can actually trade every single day, and they use this to their advantage. So one of the advantages is that the granularity of actually tracking your factor, if a stock becomes a value stock, you can just buy it right away. You don't need to wait until end of quarter to buy it. So you might actually get almost in a way more accurate, shrink-wrapped, whatever, exposure to the factor. That's sort of one benefit. But the main benefit essentially is that you can reduce your trading costs massively, and you can even almost act as a supplier of liquidity instead of a demander of liquidity. We don't need to worry about the mechanics of that, but if you need to buy, we're just going to make up numbers. Let's say you need to buy $10 million of a certain stock. You don't need to make that trade in one day. You can just, put your order in the order book. You can sit for a while. You can do a little bit today, a little bit tomorrow, a little bit tomorrow. And because you're not just having this massive surge of volume, you're not going to bid up the price a little bit and get a little worse prices because you're demanding all this liquidity. You can slowly trade, and you can massively minimize your impact on the market if there's that much volume. You can, have less cost, less spreads, whatever, right? So that's another advantage. And then let's talk about further advantages. So one of the other benefits is they can actually look at the research, the same research that I've looked at, and they can use the financial science and implement some of this stuff into their fund. So again, I talked about how, value and profitability, mechanically, you might want to target jointly, and then other things you might want to target separately. And we could talk more about that later. And then I brought up in my last video, I brought up momentum. And momentum is a very high turnover strategy, and you could target momentum on your own, and I actually do that personally just because that's what I want to do. But, it's like a high spread, high cost, high turnover strategy, which incurs high fees. And, whether or not you want to target momentum on its own is a different question. But within the context of other factors, within the context of value, and within the context of profitability, it turns out you can actually get better returns and lower your risk and have a more desirable portfolio if you implement momentum as a trading screen. It's just like a negative screen. You're not seeking momentum actively. It's just like a passive trading screen. So, for example, we know that value stocks are stocks that are cheap in price. Let's say there's a stock that you don't currently own, and then it goes down in price. And of course, we're not talking about absolute price. We're talking about the price of the share scaled to some fundamental metric that could be on their balance sheet or on their earnings statement. But we're just going to make things simple. Let's say there's a stock that isn't a value stock, so your value fund does not own it. And then let's say it drops down in price and becomes a value stock. Well, the value fund would just buy it right away. And that's fine. You could do that. But if it enters your buy list, but it still has negative momentum, you might as well just wait for that negative momentum to dwindle out, and then you buy it. And now you're avoiding having negative momentum. In fact, we know already that value strategies are short momentum. That's just how it works. So you might as well have this value strategy where you're sort of not short momentum and you're not really actively harvesting the momentum premium, but it will just help you. And then same on the flip side, if there's a stock that you own already and it gets more expensive and now it's not a value stock, it's like a growth stock and it enters the sell list, you could just sell it right away. But if it has positive momentum anyways, you might as well hold on to it. Extract a little bit more return, wait for the momentum to dwindle, and then sell it, right? When we look at the research and we look at all the stuff, it seems like a reasonable thing to do, and that's something that this fund, for example, implements, whereas a fund that strictly is just tracking this S&P index is not going to do. So that's just one other example, and there's many different sort of examples like this. This is not an exhaustive list. Okay, so another interjection, right? I was editing the video, and I literally would have just said that this is not an exhaustive list. And, it's not an exhaustive list. There's plenty of things that these, quant factor funds like Avantis will do in an attempt to, follow the data, follow the financial science, and give you higher expected returns and, increase statistical reliabilities and all that stuff. There's many of these things. I'm just sort of highlighting the most important ones, the most interesting ones, right? And then I realized that, I didn't actually touch on investment yet, so I definitely didn't want to end the video without touching on investment. So just to give a little recap, right, just for these Avantis funds, this is just a paper called Our Scientific Approach to Investing. This is just on the Avantis side. Again, DFA and other firms might do things differently, but just to give a little recap, right, Avantis is going to target value explicitly, and they're going to target profitability explicitly, and obviously size if it's within a small cap fund. And then as I just finished explaining, when it comes to the momentum factor, they don't explicitly target momentum. They just use momentum as a trading screen. That's what I just explained. I figured this is a good spot to talk about investment, since they do a similar thing for investment, except instead of investment being a trading screen, it's actually an exclusion screen. They actually exclude the stocks with the most aggressive investment. So let me just touch on investment just real quick. As you would have seen at the start of this video, I had that slide just showing a bunch of equity factors. We had size, value, profitability, momentum, right? And then one of them is called investment, and I didn't actually touch on investment yet in this video or in my other videos. And the thing for investment, at least for Fama French, how they define it, is called CMA. And CMA means conservative minus aggressive. That means essentially that stocks that have conservative investment practices are going to provide an excess return over companies and stocks with aggressive investment practices. So I'm not going to read this whole thing, and you can obviously read the research, but just to essentially say what that means. Now, you're going to have some intuition behind what I'm about to say if you would have watched my market efficiency video. Unfortunately, I didn't actually show I didn't actually show investment through the lens of a discounted cash flow. I did show profitability and value through the lens of a discounted cash flow. I wish I did. But essentially the point of that video was essentially saying, I would have told you that the company's discount rate is the investor's expected return. And the point with all this factor stuff is we essentially want to target the subsection of companies that have the highest discount rates, since the highest discount rates give the investor the higher expected return. And then I also would have told you that the discount rate is the company's cost of capital. Now we can use investment as an additional metric or signal to sort of further like narrow down these discount rates. So I'm not going to read this out, but we can take a look here. And yeah, as I said, high investment companies, meaning companies with high level of asset growth, tend to underperform companies that have lower investment. And then the rationale behind this, and it makes sense if you think about it, companies tend to raise capital when their discount rates are low, right? If the company's cost of capital is low, it's a good time for the company to raise money. That's going to make it, a company with high level of asset growth. But then if you think about it, you don't really want to be investing in the company with a low discount rate. That's actually what we're using value and profitability to avoid. You want to target high discount rate companies, since a higher discount rate literally mechanically means a higher expected return for you, the investor. So that's really just sort of like what the rationale is behind investment. And then in this case, what Avantis does is, again, you could just do an actual sort on investment and target investment. That's like how CMA, the actual theorem of French factor, works. But what Avantis does is they just do an exclusion screen. So they state that they exclude small companies with high prices relative to their equity. That just means they're excluding tiny companies that load negatively on value, right? Expensive companies and low levels of profitability, which means companies with weak profitability and high asset growth. That's the aggressive investment. So essentially what this means is that small cap companies, small cap growth companies with weak profitability and aggressive investment, this tiny little subset of stocks that would have otherwise been eligible for purchase is now being excluded. So similar thing, they're not explicitly sorting or targeting investment, similar to how momentum's a trading screen, investment is an exclusion screen. And of course, you can go through, read the data, do whatever you need to do. But again, it's the same conclusion. They're using these factors, using the data, using the financial science, right? This is just another further screen of how these funds can try and extract additional expected return over a traditional index fund. I just would have been upset if I uploaded the video without even touching on investment. Obviously, as I said, right, there's a bunch of different, a bunch of different things they do, essentially. Now, another thing that this category of funds does, DFA and Avantis, that these funds do not do, is they can actually do weighting based on the signal. So when we look at these regular funds that just track an index, they might do something like this. I wrote down value plus profitability. You can pretend it just says value or just says profitability. I don't even think there's an offering right now in the market that does value plus profitability that just statically tracks the index. But either way, whatever your signal is, value, profitability, momentum size, whatever that signal is, what the indexes more or less will do, if you simplify, is they'll just do a sort on their factor. And then there's, some concept of concentration. Do you grab, the top 1 decile of cheap stocks or 2 deciles or 3 deciles? How many stocks do you actually grab? We're not even looking at that. I'm just making up the numbers. They just grab some number of deciles of value stocks or momentum-y stocks or profitability stocks. And then they're just going to hold the ones that they pick in market cap weights, and all the remaining 7 deciles that they don't pick, they're going to completely exclude. And then once a stock comes from here on value to inside the buy list on value, they go from not holding it at all to holding it completely. That's a depiction, a simplified depiction of what the regular index tracking fund would do. What Avantis and DFA do is they can actually weight the stocks based on the signal. So the more value-y and profitable, or in theory momentum-y, or in theory low vol-y, you know what I'm saying? Like whatever your signal is, the more it ranks on that signal, they can weight it more, and the less it ranks on that signal, they can weight it less. That means many different things. That means that it could increase the reliability of your returns. It also means, remember that whole skewness thing? You can catch winners more early on, and then as it Like, you know what I mean? Again, like it's really not like a huge deal, but it's just cool to sort of introduce this third category of fund that is almost in spirit still almost like an index fund. These things are just like little tweaks at the margin. It's definitely not the make or break. I just thought I would share how you can improve portfolios. I don't want the focus of this to be specifically just on those two fund providers. Again, anybody could, in theory, do this even with direct indexing if you have that trading infrastructure. That's really all I'm doing, is just sharing information. So that brings us to the end of this part of the video. Really all this sort of, I guess if I had to like summarize this, I would really just say that everybody is already a factor investor, whether you like it or not. You can already decompose the returns of your own portfolio or your own manager into the small number of known risk factors. Almost any return from any manager can be almost fully explained by their exposure to these known risk factors. If you just accept that fact and go out and just get exposure to these known risk factors anyways, you can do it in a more efficient manner, a more diversified manner, a more statistically reliable manner, and of course a more cheap manner, which can raise your rate of return, since again, on average, after fees, you're probably going to underperform if you're doing like a traditional active strategy. And of course, if you're already doing an index strategy, you can, again, rather than just harvesting one factor, you can harvest multiple factors, which all have, even if you're long only, obviously they still have a correlation of less than 1. It's not a perfect correlation that can still help to increase the reliability of returns. That's just one of my methodologies behind investing, is being a multi-factor investor. Okay, so welcome to the coding part of this video. If you actually stuck around for that long, that's actually kind of insane. I knew it was going to be a long video, but I didn't know it was going to be this long. I don't know if you can tell, my voice is literally destroyed from talking for that long. Anyways, or if you skipped ahead, welcome. As I said at the start, this is actually going to be really simple and really short and really easy. We're actually not even going to write that much code, since as I said, we are going to be abstracting the actual mathematical regression, OLS regression, to a Python module called stats models. So there's really not actually that much code. I think we only write, I don't even know, it'll probably be like 30 lines of code or less, to be honest. And then, as I said, last thing, I will be assuming that everybody watching past this point did watch my Quant Finance 101 video, so we're not going to be repeating, the same stuff. So yeah. So last thing, just for those of you that might not be familiar, we're going to be doing this whole video in a file called .ipynb for Interactive Python Notebook. You can go ahead and do this in like Jupyter Lab or Jupyter Notebook or whatever. I just prefer to use VS Code personally. You can literally just create a file and then give it file extension .ipynb. The first time you do this, it will probably prompt you to install like the Jupyter extension or whatever. There's really not that much to it. You just pick a Python kernel up here, and then we have this concept of cells where you can just run raw Python code in a cell, and then you can reference it, for example, in another cell. The last variable referenced in a cell, just left dangling in a cell, will be printed by default, so you won't see me actually doing explicit print statements most of the time. And then in another cell, the state is like saved. So for example, if we add 5 onto x and then print x, now it's 15. It essentially almost lets you pry into like a Python runtime in real time. Again, this is used broadly throughout all numerical, mathematical, statistical applications within Python. So it's just something good to be aware of. And yeah, so let's get started. So let's just go ahead here and start with our imports. There are going to be 5 dependencies total in this project. So of course we're going to need to import NumPy, and we're going to need to import Pandas, and we're going to need to import yfinance as YF. Of course, we already used these libraries before in Quant Finance 101. These should be self-explanatory. That's just the bread and butter for dealing with numerical stuff in Python. And then that's what we're going to be using to source our data. In this video, I'm just going to grab some ETF data and then run factor regressions against some ETF data. Of course, you can upload a CSV of your own personal brokerage account performance. You can really, run it on whatever you want. And then we're going to need 2 additional dependencies. we are going to be importing stats models. Specifically, we're going to need to do statsmodels.api. Normally, we just say as SM for stats models. That's going to be the library that we're going to use to actually run the OLS regression. The type of regression we're running is just going to be an OLS regression. OLS means ordinary least squares. That's one of the, there's different types of regressions you can run, and we're definitely not going to get into that in this video. But just to sort of show you, right, if you wanted to do like a factor regression on Portfolio Visualizer, for example, it will actually ask you for the regression method. This one supports OLS and Lasso. In my video, we're just going to be sticking with OLS. That's obviously like more than good enough for the scope of this video. And then lastly, we're just going to need a way to source data for the actual factor model that we want to regress our returns against. Of course, in this video, I said I am going to be using Fama French data. Now, when I first got into this in like first or second year of my undergrad, would have been, I guess, 4 years ago by now, maybe almost 5 years ago by now. It's actually been a while. But when I first got into this, I originally sourced data from a library called Pandas Data Reader. And then that would actually go and fetch like Fama French data or plenty of other data types for us. I think it actually also, if I'm remembering correctly, actually got data from like the Fred and stuff as well in the US. Anyways, it turns out that PDR, Pandas Data Reader, is deprecated now, so you can go ahead and download it yourself and upload a CSV or write something to scrape it, because from the Ken French data library, it actually gives you a zip file. Either way, it's no big deal. It turns out somebody actually wrote another library to take its place, which is awesome. That's literally just called Get Fama French Factors. We'll just import it as GFF for Get Fama French. Now, if you want to regress returns against a different model, you're free to go ahead and source your own data. I'm really just giving you the blueprint, and then, you're free to really just do whatever you want to do with it. And then last thing here, if this is your fur, we can go ahead and execute this. For me, it will execute fine, but for you, it might say not installed or whatever. Again, an easy way to install it in the right environment is just to open up a code cell and do the Python %, which is a magic command, like time it and all that, except you can just directly do pip install. And then you can literally do, like pip install NumPy, and you can just pip install all of these directly there. Obviously, for me, it's already installed, already satisfied. But just for completeness, just so everybody can follow along. And then, yeah, you should be good to go. Okay, so let's kind of just start blazing through this, I guess. There's going to be 3 parts here. We're just going to source our ETF data, source our factor model data, and then once that's done, we'll actually do the regression. Simple enough. So let's just start by sourcing just regular fund data. And again, I'm not going to give too much commentary because all of this already would have been covered in the first video. So we're just going to use the variable rets for returns, and we're going to use the download function from YFinance. And let's go ahead, and it doesn't matter what funds we pick. In this case, let's just do VTI, which is total US market, and let's use AVUV, which is the Avantis US small cap value, just because I used those as examples in my video. And then we're just going to need a couple more parameters. So again, in terms of granularity, you can use whatever granularity you want. You can use monthly or yearly or annually. In general, we're just going to do monthly. That's going to be 1MO for this function. That's just what I prefer to use in general. I mean, daily's more granular, but we're just going to stick with monthly for now. And then we are going to need to do, so you don't need to do auto adjust. In the first video, the auto adjust didn't exist. It gave you a close and an adjusted close by default, and we indexed into adjusted close. Now by default, the close column is adjusted close. This actually defaults to true. I just prefer to put this in here explicitly just to make sure the close is adjusted close. If you don't know what that means, that just makes sure that the closing price is inclusive of cash flows, meaning all distributions, dividends, coupons, if it's like a bond type of thing, right? If you just look at close prices and exclude your dividends, then you're just looking at a price-only return instead of a total return, which in general, we're not going to have any interest for, unless we do for some specific use case. And then we're going to just end up indexing into now the close instead of the adjusted close, since the close is the adjusted close. And we can go ahead and run this now, and we can go ahead and see what rets looks like. And I'm not exactly sure, to be honest, if this is intentional or not. When I first made that video a couple of years ago, this, by default, YFinance, if we don't specify a start date and an end date, it just gives us from inception, which means from when the fund or stock launched originally, the very start of the data set, to the very end. For some reason now, it only gives us the most recent data point unless we explicitly put in a start parameter. It almost seems like that's not expected behavior. Either way, it's no big deal. We can just go ahead and specify now, you can put in any date here as long as it's before the inception date. Of course, any ETF, I mean, SPY was the first ETF in 1993. These ones are after 1993. Again, it doesn't matter. Just put in some start date, run that, and we should be good. We're going to have now from inception all the way until the most recent date. And now we can go ahead and just do a little bit of cleanup since we have some NA values. And even though we source some monthly data, the timestamp still says 01 as if it's the first day of the month. In reality, it's actually the close of the month. It's actually the last day of the month. It's just the timestamps come through looking this way. So real quick, we can just go ahead and fix this up. So let's go ahead and set rets equal to, first of all, we're going to do to period, and we're going to set that to monthly. We can do this step by step. So now when we run this, that's just going to get rid of that annoying -01. We obviously don't need a day when we're just dealing with monthly data. And then second of all, again, these are prices. We want to convert from these arbitrary prices to actual returns. So to do that, we're going to do %change. And then when we run the %change, it's actually going to add in one additional row of an NA value. Of course, we have a bunch of NA values since VTI and AVUV have different inception dates. So then what we're going to do is we're going to do .drop NA. That's going to drop every single row that has at least one NA in the row. So now when we run this, now these are perfectly aligned. AVUV launched in 2019. Of course, this is not that much data for when we actually run the regression, but this is really all we need to do. And you can literally just replace these tickers with any tickers you want. And yeah, and we're already done. That's already all we need to do to source our actual fund data. So now let's go ahead and source our factor model data. As I said, to make things easy, we're going to be using this brilliant library, thanks to one individual, I guess, that created this. It's extremely helpful. You can go ahead and read the documentation. There's really not that much to it. I think there might only be 3 or 4 methods in total. In fact, what we're going to be doing is Fama-French 5 factor and then momentum factor. And again, this is a library that just sources the data from the Ken French data library, just to save a little bit of code. The actual underlying data source, again, everything will be linked in my description, even all the papers I talked about for the last 2 hours. But this is something called the Ken French data library. This is the actual data source. This is maintained by Ken French. This is what was actually used. This is the actual models from all the Fama-French papers and Fama-French models. So, we have 3-factor data here, and we have a bunch of different factors, and we have the momentum factor. Even though Fama-French didn't include momentum in their model officially, they still happen to provide data on the momentum factor. So this suits our use case. And of course, you can go and source any data from any asset pricing model, but we're just going to be using Fama-French data. So this is actually going to be really simple. Let's just go ahead and make a new cell here, and let's make a variable called Fama-French 5 factor model. And then of course we already imported this as GFF. So we're going to do GFF dot Fama-French 5 factor. This is just a function. And if you run this, that's really all we need to do at first. This is going to give us the model. So let's take a moment now to actually look at what we got back. So first of all, again, ideally, maybe this wouldn't be intentional. We're just going to fix it up ourselves. Ideally, the index in the actual data frame would just be the dates. And because this is monthly data, again, we're getting month-end data. We don't need to worry about the dates. So we're still going to go through and fix this up. But if you look at the actual data we get back, so there's 5 factors in the 5-factor model. There's the equity risk premium, which is called market minus risk-free. Then there's small minus big for size, HML high minus low for value, RMW robust minus weak for profitability, CMA conservative minus aggressive for investment. And then we have the risk-free rate in and of itself. We don't want to hand the risk-free rate in as an explanatory variable. When we do the regression, we're going to slice this out, but we actually need to use it to calculate excess returns on our own stocks. I'll be covering this in a second. I'm kind of getting ahead of myself, but let's go ahead and fix this up. So we're just going to need to chain 2 methods together here. So first of all, we're just going to do .set index. And this is going to make the actual now default numbered index of the data frame. We want to make it the date index. So we do set index, and then we just hand it the name the name of the column. So we can go ahead and run this, and now this already looks a lot more clean. We obviously want the index to be the dates, and then we can also now go ahead and just do the same dot to period M to make it monthly. We can run this. Now we don't have that weird, messy month-end time step. It still is month-end data. We didn't change the data. We're just making things clean. That's really all we need to do. And this is now a complete 5-factor model. So this is actually not in place by default. So we would technically need to do this just to make sure it's actually assigned to the variable. Or we could just do something like that if we want to clean things up. It's really no big deal. It's the same result at the end of the day. Now, I didn't actually explain, so you understand what the 5-factor model is from watching the video, but you might be asking, like, what actually are these numbers? Like, what are we actually looking at? These numbers are literally just returns. So the same way we're sourcing returns for these, and, rets is full of returns. These are literally just returns, but we're essentially just saying that each factor is a portfolio. So this is the market portfolio minus the risk-free rate. This is the size portfolio. This is the value portfolio. And if you did what FEMA and French did, and you took a bunch of underlying data that's not here, if you took the company price and you looked at the balance sheets and the earning statements, and you did this immense amount of research, and then you actually did this sort on big stocks and small stocks and took the top decile of big and small and minus each other, and you made this long-short portfolio, if you actually held the portfolio of the size factor, these would literally be your returns. So we can plot these out, right? Let's plot these out first. So you think back to that last video, we just do 1 plus R, right? Rets is a return, and then we do .cumprod for cumulative product, and then .plot. And if you plot this, it doesn't look the best since there's not that much data, but obviously this is how that looks. In fact, if you wanted to just do some more data, this might just look a little better. You can obviously see that we're just plotting returns here. We can go back and use AVUV though. The same thing applies to this. So if you want to see how this looks, same thing. We can do 1 plus these returns for each portfolio of just this raw factor. And these aren't investable. There's no ETF that exactly does what FEMA French does. There's no like management fees or anything taken into account here, right? But we just do 1 plus that dot cumprod dot plot, and this is going to be interesting. Now we can actually see the performance of each factor. Let's just go ahead and do fig size equals 12.6. And this is really interesting, right? We can see that obviously the market factor, I didn't really touch that much on the concept of like long only versus long short. These are long short portfolios. And the ETFs I was talking about are long only portfolios. So just to bring some additional clarity, like let's just talk about SMB. That means small minus big. That means you do this sort on size of companies, market caps, and then you grab the top decile of small stocks and you essentially buy that, except you short the bottom decile, you short the biggest stocks. So it's a long short portfolio. Sometimes these are referred to as zero cost portfolios. You literally short a group of stocks and then use the proceeds from that to go long on a group of stocks, and you earn the spread. Like if small stocks give you 9% a year and big stocks give you 8% a year, your S&B portfolio is going to give you 1% a year. You eat the spread in between the two. That's how long short works. You're completely factoring out the market factor from these funds. If you were to just buy like AVUV, for example, that's a long only fund. That's only buying small cap value stocks. That's it. It's not buying small cap value stocks and shorting large cap growth stocks in this case. You know what I'm saying? So your return with a long only ETF is still going to be dominated by the market factor. That's sort of like how that works, if that makes sense, I guess. Again, I can make a whole video on that. But if you look at this, the ERP, the equity risk premium, is obviously providing massive returns. The other ones, of course, still sort of are positive here, but it doesn't look the best since they're long short. But the correlations, I mean, again, we can do a full analysis later. I don't really want to get into that right now. And then obviously the risk-free rate is just slowly paying you that coupon over time, and there's almost no volatility. Okay, so yeah, so that's the 5-factor model, and then we could just roll with this, and of course, as you're watching along, feel free to pull the 3-factor model, feel free to test on the 5-factor model. I'm just going to jump right to my sort of made-up 6-factor model, just because that's what I promised many videos ago. We might as well, but of course you can do whatever you want. I'm literally just going to copy and paste this, and probably call this Fama French momentum factor. And the function was literally just dot momentum factor, and that literally now just pulls the momentum factor. We can go ahead and look at this, right? And then same deal here. And then we literally just want to join these together. Again, we can do like a pd.concat or whatever, but we want to make sure the indices align and stuff. So we're just going to use the join method. So we're just going to say Fama French 6-factor model is going to be equal to the 5-factor model dot join with the momentum factor. And that should be all we need. We're going to go ahead and run this. And now we can see we have the 6-factor model. Same thing. Let's see how the momentum factor did. And now we can see that absolutely nuts momentum factor. You can see that whiplash. We call that whiplash for the momentum factor during 2008. It's actually pretty cool to see. And now you can sort of, see why maybe some people have some gripes with the momentum factor. That looks absolutely nuts. But yeah. Okay, so last thing here, just in terms of cleaning up the data, you might have noticed, right, that we have our 5 factors here, and then we have the risk-free rate, and then we have the 6-factor. Again, there's like 100 different ways to deal with this. As long as your code is like mathematically sound, you're all set, you're all good to go. The specific, like, can I use a concat method instead of a join method? There's 100 different ways to do this. But just to keep things clean, I'd rather just keep the risk-free rate as the very last column in the data frame. That's just my preference. We're going to end up removing that last column later on since we don't want to regress against the risk-free rate, but we're still going to need the risk-free rate to calculate excess returns before we do the regression. So just to move that over, again, there's a bunch of different ways to do it. I'm just going to do Fama French 6-factor model equals Fama French 6-factor model, and then I'm going to index into every single column minus risk-free. An easy way to do that is just to unpack every single dot column and then dot drop the risk-free. If you're curious what I'm doing, just to show you, we're literally just this is just a list comprehension. If I just did a list comprehension of unpacking every single column, we're just going to get that. And then if we do every single column and then we drop the risk-free is just going to disappear. And then we're doing all of this in another set of brackets. We're just indexing into a list of all of these column headers. But then what we're going to do is we're just going to hard-code one additional item into that list, just called risk-free. That's going to be like that. We literally just changed the order of risk-free. It's just like some syntax stuff. But as soon as I run this, we're now going to see that risk-free is now last. That's really all there is to it. That's the last thing of prep. Let's just clean this up a little bit, and we should be good. So just to recap, we barely have any code. We have some imports. We're sourcing our actual data. We're grabbing our models, and then we are cleaning up our models for doing 6-factor model stuff. And yeah, let's continue now. So what I'm going to be doing is just defining a function called def factor regression, and this is just going to be the main function. When we're done with this, you can go ahead and add it to your toolkit if you're following along with the other videos or whatnot, and you'll literally be able to do a factor regression at any point in time. So this is just going to accept 2 different things. It's literally just going to accept rets, just returns of whatever you want to get factor loadings for, and then it's going to accept, of course, a factor model. And that's really all we need. And there's one more sort of data prep thing we need to do before we start. If we take a look at rets, and of course we could also do this outside the function. I'm just going to do it inside the function just because that's my personal preference. Why not? But it's really up to you. There's no right or wrong answers here as long as the math is good. But if we take a look at rets, and if we take a look at our 6-factor model, we can see that this starts in 2019, and there's 78 rows, and it ends in 2026, the 3rd month, which is March, which is right now. And if you take a look at this, the data starts in 1963, and it ends in January, and there's 751 rows. Obviously, these are going to need to match. So again, there's no right answers. There's a bunch of different ways to make it match. What I'm going to do is I'm just going to be using the dot intersection method, since that's a fairly easy thing to do. So let's just make a variable called common index. We generally use IDX to mean index. Of course, it's a variable name. You can call it whatever you want. And let's go ahead and grab the intersection of the index of these two different things. So let's go ahead and do rets.index.intersection. And this is just a function that's given to us. And this is just going to return all of the dates that are present in both data frames. So 1963, for example, it's only present in one. That's going to be discarded. And the most recent one, or the most recent two, 2026, February and March, is only present in rets, not present in the model. That will be discarded. Only the ones that are in common are going to be kept. So we're calling this on rets, and then we're going to be taking the intersection with the factor model. And that's literally just going to return an index to us that we're just going to call common index. And then we just need to go ahead and set rets to rets.lock, and we're going to index into common index. And then we're just going to do the same thing here with factor model, common index. We're literally just going into the index of rets and just only filtering for the common index. And then same thing for the factor model. Now these are going to have the same index. In fact, this is a function. Maybe I actually should have done this outside of a function for now, but just so we can visualize what's actually happening. If we were to run this here, what just happened? Oh, I see. We need to do dot index. That's a good catch. Let's rerun this. Now we should be good. Now when we print rets, we can see that now ends in January of 2026. And when we run the 6-factor model, that starts in 2019. They're both 76 rows. So again, it's just one more step of data prep. I'm going to rerun these just because I now mutilated them outside of the function. But for now, we're just going to keep that in the function. We could do comments if we want. We can call this common index. And then we'll jump down here. And the next part is going to be one last thing of data prep. We can call this maybe prep data for regression. So let's just take one more look here at both our factor model and our rets. I shouldn't keep deleting the cells, but it's whatever. And there's two more things we need to do here for data prep. Super simple. As I said, when we actually run the regression, we want to run it against all 6 explanatory variables, which are our factors. We do not want to include the risk-free rate. So we're just going to need to kick the last column out of the data frame. And then I think I said it offhand before, but now I'm going to say it officially, just so you know, when you run these factor regressions, you do not want to just hand raw return data into the regression. It will still work mathematically like within Python, but you're going to get incorrect results. This is a mandatory step. Instead of handing it returns, you just need to hand it access returns. I think I talked about that a little bit before on the channel when I brought up the raw Sharpe ratio and the regular Sharpe ratio. A regular Sharpe ratio is just excess return scaled by volatility. An excess return is just the regular return minus the risk-free rate. So we're literally going to be doing for every single time step, 0.021 minus the risk-free rate. And then, these two returns minus this. And those two returns minus that, and then we're just going to call that, rets excess. So we can do that now. We're just going to do rets underscore excess, and then we're just going to set that to rets, and then we're going to use the subtraction operator, and we're going to subtract out the factor model double into the RF for risk-free, and then do dot values, and that's just going to take care of that for us. In fact, we can go ahead, just if we want to view it, we might as well just return this for now, just so we can see what actually happens. Let's just run this function, or call this function Fama French 6-factor. We're just returning this just so we can see it visually. And sure enough, this is what we have. 0.021 drop down to 0.019, and then 0.025 drop down to 0.024. It's literally just the normal return minus the risk-free rate. That's all that is. And then let's go ahead and just kick out that one final piece. So let's go ahead and do this. Let's just call this factor model minus risk-free. Why not? And then we're going to set that to the regular factor model, except we're going to go ahead. No, originally why I moved that to the end is I was just going to do something along the lines of like factor model dot columns dot values, and then like snip it from like there to -1 or something. But that's not ideal. I mean, like, it will work, but it's not ideal. Now that I'm looking at this, I might as well just change the approach and do something like that. Let's just double index, unpack everything, unpack everything, drop the RF, and obviously not reappend the RF. And we run this now, and that should be good. And just so we can, double check here as we code along, we can just run this and run the function. Of course, this outside of the function still has RF, but now when we actually run the function on rets and French 6 factor, this RF column should now disappear, and perfect. It's just a little more robust code. I guess you could remove that line now if you wanted to. It's really no big deal. Again, there's no right answers. As long as the math is good, you're good to go. Again, design of the code is really up to you. That works for now. Okay, so now we're actually going to do the actual OLS regression. So this is like the actual regression. We don't want to return that yet. And let's go ahead and let's actually do run regression. And as we said, this is going to be pretty simple. In fact, there's one sort of thing we need to do. I guess we could add that into the data prep section, is we're going to need to take this factor model now, minus the risk-free rate, and if we want an alpha term, now we could run the factor regression without an alpha term and still get coefficients, like still get factor loadings for all of the factors, but in general, we're really more or less always going to want the alpha term. Now the alpha term, I call it an intercept. We can talk about like the underlying sort of mathematics of why we need to do this later, but we literally are just going to make a column just called alpha, and we're just going to set that to a hard-coded 1, and that's literally all we're doing. And I mean, like, you can play around with this yourself. Like, if you were to comment out that line, there would just not be an alpha. We're just going to need that in order to get the alpha, since an alpha essentially is just like an intercept when we actually run the regression. You probably know what I'm talking about if you have like a little bit of a mathematical background. But for now, we can just set that to 1, and we can just roll with it for now. So when we actually run the regression, now we're going to call this variable LM, which in general just means like linear model. You can call this whatever you want. And now we're actually going to go into the SM, the stats models library that we imported here, and we're only going to need one function. It's going to be .ols for ordinary least squares, all in capital, and then we're going to hand this two different things. We're going to hand it the access returns. You need to be very careful to not hand this the actual returns. We're going to hand this the access returns, and then we're going to hand this the factor model minus the risk-free rate, which now also includes the alpha term. That's what we're going to hand this, and then we're going to go ahead and we're going to do .fit. Of course, we're going to run this and nothing's going to happen yet, but this is the line that actually makes everything happen. Let's just go ahead for now and return LM just so we can actually see what we have. And there's going to be a couple different methods we can call on this. It's actually really cool and really in-depth. So let's go ahead and call this. We'll see if we did everything right, and perfect. There's nothing to view yet, but we get back this regression results wrapper object from the stats model library, and that's good. This is exactly what we want. Now, there's a couple different methods that we can call on this to actually view information. The main one that's sort of just for like display purposes, that's going to print an entire summary of all the relevant information, is going to be called .summary. Now, .summary, technically, now we're not going to do .summary. I'm just showing you this because it's interesting. If you run .summary, it's going to fail because there's going to be some not aligned index. Essentially, if we do .summary, we're only going to be able to view one variable. We're only going to be able to view the results from regressing one stock at a time. So we can just go ahead and rerun that, and that's why it's this entire thing. In this case, just for VTI. We don't need to worry about this. This is just extra. We're actually going to be calling .params, which will work just fine with everything being vectorized. But yeah, so dependent variable, VTI, model, OLS, method, least squares, and we can view the R squared. And these are the actual coefficients. This is actually saying, this makes complete sense. VTI is total US market. Obviously, this should be having a coefficient, a market loading of almost 1, and all of these should essentially be very close to 0, since, again, market by definition does not contain any of those other factors, and the alpha is more or less almost completely 0. This is exactly what we would expect. Let's go ahead and just bump this back up now. to that, just rewriting everything just to make sure. Yeah, and then we have some other ones. So the one we're actually going to be doing is called .params for parameters. And then that's going to essentially just let us view just the coefficients now, right? And we're going to be fixing the index here in a second. But this is just the coefficients for both. And now we can see that a VUV has a really big loading on size and a really big loading on value and a really big loading on profitability. And that's more or less what we would expect. And yeah, and then just for completeness, we got also what .t values. Oh, I see, that goes back to only one. It's just for completeness, I guess, but we can do .t values, and we can do .p values, and we can do was it r underscore squared or just r squared? We can view r squared, and then I think there's like r squared adjust, whatever. There's like a bunch of, we don't really need to worry about this. Again, if you don't know the stats side, it's really no big deal. But if you do, you might know what I'm talking about. But let's just go ahead and change that back. And yeah, and what we're actually worried about is just .params, and that's what we're going to be dealing with. So we can go ahead and fix this up now. So instead of LM, what we're going to do now is we're actually going to keep on working with this data. So let's define a new variable. Let's call it factor loadings, since really the only point of, we're almost done. We're just going to clean this up. This is the actual info we want. And then we're also going to calculate an annualized alpha, right? This alpha is technically now a per period alpha. This is also a decimal, not a percentage. So now we have the data we actually need. Now we're going to go and clean this up. Let's just make the variable now called factor loadings, and let's just set that to lm.params. So factor loadings is now a data frame that contains this data frame. That's where we're at. If you want to just double check, let's just return it, run that, and that's what we're left with at the moment. Oh yeah, and then last thing, we just want to fix up the columns. I don't know why I keep deleting my cells. We need to just remember to leave this here. We're going to keep on calling this function, but right now it's just 0, 1. We can fix this up super easy. We can just do factor loadings dot columns, and then just set that to rets.columns. And then that should fix that up for us. Let's run, and now we got, a VUV, VTI. So yeah, we should be good now. Okay, let's go ahead and kind of blaze through the rest of this here. We're basically in a way done. Like this is good data, right? We already did the regression. There's really just 2 more things we want to do to clean up. First of all, we want to probably have an additional row here called annualized alpha, so we can quickly at a glance see, what the overperformance is of a strategy per year. Again, this is just per period alpha, and then we still want to keep in the per period alpha, but we probably want to make this a percentage, since right now it's a decimal. So it's really just some more cleanup. We can honestly get through this pretty quickly. So let's go ahead first, and let's just do calculate annualized alpha. So let's grab our alpha per period. Now we need to be careful because we also want to round these numbers. It's up to you. You don't need to round them. I'm just going to be rounding these numbers to 2 decimal places. So we need to be careful to not round the numbers and then do further computation on the numbers, since then, we're dealing with a loss of information. So we gotta put some things in some variables here. So let's just gather the information that we need. So we want to know the alpha per period. That's already in this row. So we can just grab that by going into factor loadings dot lock of alpha. That's just going to give us the raw alpha numbers. That's per period, and that's in decimal form. Now let's go ahead and calculate annualized alpha. And let's think back to how we annualize a return. Again, the alpha in this case is just a return at the end of the day in decimal form. So how do we annualize a return? We can go ahead and just do 1 plus r, where r is now just the alpha per period. And then we're going to go ahead and raise it to the number of periods per year. In this case, I'm just going to hard code a 12. Of course, you're free to go ahead and have a periods per year parameter there. Or of course, you can also actually read the index and infer it. In this case, I'm just going to leave it as a 12. But you know what? That can be a challenge for the viewer. If that's something you want to correct, you can easily be running daily regressions by the time you're done with this. But I'm just going to leave this as 12 for now, and then we're just going to do the -1. If you really want to make sure, we can do brackets like that. It's really no big deal. That's going to be our annualized alpha. And then what are we going to do after that? Let's do annualized alpha. So this annualized alpha is technically an entire data frame, since we're double indexing. Again, the first video you'll kind of explain, but this annualized alpha thing is technically still a data frame. We now want to go ahead and just set the index of that data frame to the new title. We're going to call this just annualized alpha. Might as well make it capitals. And if we want to return this data frame, just so you can see what we did, right now we just have annualized alphas. That's all we did, and now we actually want to concatenate it onto the same data frame. So let's just do factor loadings is now going to be equal to pd dot concat of, let's concatenate the original factor loadings with annualized alpha. Now we can just return the original factor loadings data frame. And now we have alpha and annualized alpha. Both of these are still in decimal form, not percent form. That's just going to be the last thing we're going to clean up here. So let's go ahead. Last step here, and then we're actually completely done the video. So last little section here, we can just call this alpha and annualized alpha in percent. And let's go ahead and let's think about things, right? So one of the things I want to do is I also want to round these numbers. Again, it's completely up to you. In general, I think most of the time on Portfolio Visualizer and stuff, they're probably going to quote the coefficients 2 decimals out. It's really no big deal. It's up to you. I just want to round these numbers. So I'm just going to go ahead and do factor loadings equals factor loadings dot round to 2 decimals. We can run that and run this, and you see everything drop down to 2 decimals. It looks like we lost information for alpha and annualized alpha, which we did right now. We did with what's highlighted, but of course in the function we still have alpha per period and annualized alpha saved in variables with the full number of decimals. So it's no big deal. We're not actually destroying anything. Everything's actually fully intact. Now this one more line, we need to do one more thing before we can actually just make them percentages. It's technically optional because it's up to you. Now, I like to know when a number is a percentage by having a percent sign next to it. That's just my own personal preference. It's completely up to you. There's no right answer. We could also just say alpha and then put a percent there in brackets in the actual index name, but I just want it next to the actual number. Again, like there's no right answers, but if we want to put a percent sign next to the number, it's going to give us an error. Since if you look at the type of the data frame, not type, data type, D type of the columns within the data frame, D types of the data frame, we can see that we're dealing with float 64s. Obviously, this is numerical. And we can't actually put a percent sign that's going to make it a string, and we can't actually mix a string. You used to be able to in the past, but Pandas actually got more strict with mixing types. So we're just going to need one line to correct that. We're just going to say factor loadings is equal to factor loadings.asType, and then we're just going to turn it into an object. Now when we run this and look at this, it doesn't look like there's a difference. Of course, it might have just took off those last little zeros there, right? Let me just double check on that. Yeah, it just condensed it down is all. That's expected, and that's all we're doing. Let's keep on going. So let's get this done. 2 lines here, and then we're done. So remember, we're literally just turning alpha and annualized alpha from decimals into percentages. So let's go ahead and do factor loadings dot lock double index into alpha, and then this is going to be the same thing except for annualized alpha, and then we're going to be setting this, right? So it looks like we lost data since we rounded. We did based on what's highlighted, but again, obviously we stored this up here. So alpha is just going to be the alpha per period. We're going to multiply by 100, and then this is going to be the annualized alpha. We already have in a variable, and we're going to multiply this by 100. And because we want to now, so we already multiplied by 100, and now we just want to do the as type, except we're actually going to need to round these first. So we're going to, first of all, do dot round to 2. This didn't take care of it, of course, because these are coming out of the variables. And then once we round, we want to append a percent sign. But to do that, we're actually now going to need to do dot as type stir, just to make them strings. And again, this object did not make them strings because, again, these are not in the data frame. These are just variables. So we're just making them multiplying it by 100, so it's a percentage, rounding it back down to 2, casting it to a string, and then adding on a percent sign. And that should be a plus. Oops. And yeah, so boom, boom, and let's run this, and let's run this, and boom, done. And we're actually done the function, and we're actually done the video right now. This is a fully intact, fully working function, really not that much code. In fact, there's barely any code in the notebook at all. And this is now our factor regression. We have all of the coefficients, right? So, and it makes sense, as I said. I kind of did a little preview. Obviously, AVUV, just to get the intuition, we can see that it positively loads on size, it loads on value, and it loads on profitability. Obviously, AVUV is literally, just in case you forgot, AVUV is literally a small cap value profitability ETF. And surprisingly, the value does not have negative momentum. If you remember what I talked about at the very end of the video, at the very end of the non-coding part of the video, right before the coding part, I said that Avantis has momentum screens to avoid negative momentum from seeping in. And sure enough, now of course 0.01 is not really targeting momentum, it's just not negative momentum. Now if we add to this, let's just randomly pick, let's just say VLUE, which is just an iShares value ETF. Now this doesn't target profitability either. Again, this is by no means like an actual analysis, not even close. I'm just giving some intuition just to sort of show the code is working in a way. But if we go ahead and add on VLUE, as I said, value is expected to be short momentum. Now we can see a little negative momentum coefficient on this value. It still has exposure to value. This is not a small cap fund, so there's not a high loading toward that, and it also has nothing to do with targeting profitability. So this is sort of how we can do this. And of course, when we do this, and of course, right now we're doing this on an ETF. So it's obvious that the market loads on market. It's obvious that value loads on value. But the point now is you can go ahead and you can look at your monthly brokerage statements. And you can actually, and I'd actually recommend you do this. Now, of course, it depends how much data you have. If it's just a couple of years of data, there's so much noise in that, it probably won't matter that much, but you can literally look at your monthly brokerage statements and look at the return, and you need to pay attention to if they're quoting you a time-weighted or a money-weighted return. I actually might even do a whole video just talking about how to benchmark your own portfolio, maybe. There's not even that much to it, but you can throw that into a CSV, import that, and then, into Python, into your notebook, and then start doing all that stuff. In fact, that website I talked about, I actually probably will put it on production. I just have so much stuff to do in personal life, but I will put it back in production sooner or later. You could actually upload CSVs to that website. I actually use that website. It's literally just like a web UI wrapper for the stuff we're doing in the notebooks. But yeah, and then, we see the annualized alpha is working just fine. And yeah, and you can again pull data for actual real world, actual active funds and actually do factor regressions. You can also go and compare this to what Portfolio Visualizer or something else tells you. But again, doing it yourself in Python, you can add on momentum, right? It's just like a blueprint. You can use this for any data, any factor model. And yeah, so I think that's really all there is to it. That was honestly longer. The coding part was longer than I thought it was going to be. And the non-coding part was longer than I thought it was going to be. And my voice is dead right now. But yeah, if you guys made it this far, I literally love you. Let me know whatever you want in the comments. And thanks for watching. So I finished filming the video, and I realized that there's two things that I left out, so I'm just going to cover those now. The first one is quite simple, and it's just something to be aware of. So as I said, all of the code that we built in this video is really just like a blueprint, right? So in this video specifically, we just so happen to use FAMA French models, and then we used this specific Python library to source those models. But of course, as I said, you're free to use any other type of non-FAMA French factor model. And of course, I'm sure there's plenty of other Python libraries for sourcing data, or obviously you can just download it as a CSV and import it, right? There's plenty of different options. And then same for the data that we're actually running the regressions on. In this case, I just used YFinance. I like YFinance. I just think it's easy to quickly just source ETF data or fund data or stock data or whatnot. I brought that up at the very start of the video when I ran those two simple quick examples against the equally weighted S&P ETF and the dividend paying S&P ETF, right? Those were just US ETFs, and those just had whatever it was, maybe like 15 years of data or something. Obviously, if you're using ETFs, you're only going to have 15 or 20 years of data if you're lucky, right? In reality, maybe you want to look at underlying index data. So maybe you want to source, MSCI or S&P or FTSE or Russell data directly, and then it can be globally, and it can go back decades and decades and decades, right? ETFs are relatively new. Anyways, so that's just sort of an aside. But the point that I wanted to make here, this is just something to note, is that you need to make sure that the geography of the funds that you're running the regression on matches the geography of the actual factor model that you're using. So in this video, in this case, everything we did is okay because we only encode, right? We only touched US-based funds. So VTI is just total US market. AVUV is Avantis, small cap value with profitability and all that stuff within US stocks. The VLUE is just a US value. And then I didn't actually explicitly mention it, which is why I'm mentioning it, which is why I'm going to bring it up now. But these methods here built into this specific Python library, right, the Fama French 5-factor, momentum factor methods, these are returning the US versions of the factor models. That means that when Fama and French, actually created these models and got this data from actually looking at stock prices and balance sheets and earning statements, and when they actually got this underlying data, this was only within the US market. This library does not state that explicitly. Let me just pull this up. So this is what I was going to mention. Yeah, so this library, as far as I can tell, unfortunately, it didn't state that explicitly, that when you call the 5-factor method and you call the 3-factor, right, and momentum, when you call these methods, you're only getting US data. We can take a look at the actual Ken French data library to see what we're actually getting, right? This is just the Ken French data library. We scroll down here. The first tab is just called, US research factors. And then this is the specific 5-factor model we were getting, was Fama French 5-factor under US data, right? And again, we only touched US funds, but maybe, for example, right, we want to do, let's say instead of AVUV, there's another one called AVDV, which is small cap value profitability within developed. And then maybe instead of VLUE, there's another fund called IVLU. And this is the same thing, except it's, international or developed value, right? So if you wanted to do something like that and you use the US-based factor models, that would not be too good, right? That would not be accurate. If you look at the data library, right, if you look at 5-factor, we can see that if you scroll down, we have developed market factor models. We can see the 5-factor, developed momentum, right? If you scroll down to the bottom, we can see that we have emerging market factors, right? And then, we have the momentum within emerging, 5-factor within emerging. So you just need to make sure that you're in alignment. I just wanted to bring that up just to make sure nobody sort of goes down the wrong path. Now, it might seem like a little extra burden that you need to sort of be aware of this. And you're not wrong, it is an extra burden, and the same thing sort of exists regardless. So even if you go on a website like Portfolio Visualizer, as I said, it's going to ask you, right, this is just doing a factor regression on Portfolio Visualizer, it's going to ask you for the factor model. So same thing, you can choose Fama French, AQR, or something else, and then specifically within Fama French, you can choose, the 3-factor, or the 5-factor is what we did in this video, but then it's also going to ask you for the stock market, and this is just defaulting to the United States. But same thing, you would need to change this, for example, to like international developed if you want to do an international fund, or you can get even more specific. So that's just something to be aware of. And then, yeah, I just don't think this library stated it explicitly. I was actually pulling up the source code for this library, and I was looking through this, and there was this array that was defined here called text to search. They were just doing some web scraping stuff, and from what I could find personally, they were just searching only within the US factors. That's literally just what I found from reading the source code. So maybe look for another library, right? It was the same thing here, right? In this video and in a couple previous videos, I was showing this sort of website. This is my own website. As I said, when I first built this, I used a different library that's now deprecated called PDR, Pandas Data Reader, MTUM. And then I even showed the example here that I had a dropdown where I actually did my 5-factor plus momentum within US, within developed, and within emerging. So that's all I wanted to say, just to make sure nobody sort of goes down the wrong path. Okay, so that was just a digression. The second thing now, and the final thing that I left out that I definitely want to cover, right? If I posted this video and forgot to do this, I would have been pretty upset. There's probably a bunch of other things maybe I'm forgetting, but this is actually probably the most major, is I wanted to do rolling regressions. Rolling regressions essentially perform a factor regression over like a sliding window. It's the same thing as doing rolling returns, except we're actually going to get factor loadings for each fund, at some sliding window. And then what that enables us to do is we can essentially see how these factor loadings vary over time. Again, if we just run this on a fund that's supposed to track value, it shouldn't vary that much. But then if you ran this against like an actual manager or something, it actually might be really interesting to see. So I'm just going to do that now, and I'm gonna try and blast through this because this video is incredibly long, and we already have the foundation, but it was the same thing here, right? It was the same thing in this video. I showed here, right? This is an example of me plotting a rolling regression, and we can see S&B, HML, right? Profitability, investment momentum. We can actually see how these might vary over time, and we can plot those. So that's what I'm gonna be trying to blaze through right now. So what I'm going to do is I'm just going to grab this entire function that we wrote, and I'm literally just going to copy and paste it, and I'm going to make a different function now, just called, let's say, rolling factor regression. Now, again, as I keep saying, right, there's 1,000 different ways to do everything. How I'm going to do this is I'm just going to do this like explicitly within Python. You're going to see in a second, I'm actually going to create this sort of sliding window, and I'm actually going to iterate explicitly in Python with a loop or with a list comprehension. It might not be the most efficient. There are ways where you can do like a dot rolling method directly within like a pandas object. You can also do like a rolling OLS directly. So that was from stats models dot regression dot rolling. You can actually import a rolling OLS. It's right, so you can do it. You can sort of do this rolling sliding window thing either within pandas directly or within stats models. I'm just going to do it explicitly. It maybe will be more inefficient time complexity wise, like code actual execution wise, but it can also give us a lot more flexibility in certain cases. I'm just going to sort of stick with that approach just for this video. So I'm just going to keep things as easy as possible. So all this alpha stuff. So it turns out that the alpha stuff isn't like mandatory. Again, you're more than free to leave in the alpha stuff. That can even be like an exercise for the viewer. But it turns out that you actually don't need to get an alpha when you do these regressions. You can just get the coefficients or the factor loadings. For the rolling analysis, I'm just going to do that. Maybe the plot will look a little more clean. It's really just so we don't need to deal with all the rounding stuff again and make it numeric again. It's really no big deal. Again, we're just simplifying for the video. There's a bunch of ways to do everything. But let's go ahead and get rid of that. We're going to need, at the very least, this line later on. But let's go ahead and start coding this. So let's do this window stuff. So again, I'm going to try and blaze through this, but let's take things step by step. So we're still just going to, prep the data, leave in the common index. And then before we actually run any regressions, we're really going to be running one regression for each window. So we are going to need a parameter now called either window or a roll window. And if you've done like a rolling returns before, this might be a little more intuitive. But right, essentially we're going to be doing, if we do like a 36, we're just going to default this to 36 months. That's just 3 years. That means that we're going to look at 3 years of data and perform a regression and, get this entire chart, all the loadings for 3 different years of data. And then we're just going to slide it up by one single month and then get, our regression based on 3 more years of data. Slide it up by 1 month, get a regression based on three more years of data. That's all we mean when we say rolling. And because we're doing this explicitly in Python, we can go ahead and see how these sort of windows look. I'll print it out and then it will become a lot more clear what I'm saying. So the first thing we're going to need is just something called n periods for number of periods. We can go ahead and back that out with rets.shape of 0. That's just how many samples we have, and they're already aligned. So, we could do rets or factor model. It's the same thing now. And now what we're going to do is we're actually going to define our windows. I'm just going to make this a list comprehension. And again, bear with me, right? But we're just going to do start, and then we're going to do start plus the roll window. And then this is a list comprehension. So we're going to be saying for start in range. And then let's think about what the range is going to be. The range is essentially going to be the number of periods, right? The total number of periods in our sample. And then we're going to subtract the roll window. And then we're just going to need to do +1 just because of the way indexing is going to work. And again, I know maybe I'm blazing through this, but we can, for example, just go ahead and return windows just so we can sort of start printing this out just so you can see what I mean. This is just going to show us the months contained within each data point of the rolling analysis. Let's go ahead and call this here. And this is what we're talking about. So the very first sample is going to be from month 0, from the first month to month 36. And then from month 1 to month 37, and then from month 2 to month 38. And then this is going to go all the way, right? In this case, there's 76 samples. Then we're going to be going from month 40 to month 76. So these are the actual roll windows. Every single one of these contains 36 months now, since that's what we set the roll window to. If we, for example, set the roll window to, let's say, 12 months, each of these now going to contain only a single year of data. Now we're just doing, months 1 to months 12, and then, we're just offsetting that by 1 month every single time. That's really all we mean by rolling. Now, obviously, we are just going to need somewhere in this function some condition to just make sure, what if we don't have that much data, right? What if we set roll window to, 100 months and we only have 50 months of data? So we're going to need a safeguard somewhere. We're just going to say if the number of periods in our sample is, let's just say, less than or equal to the roll window. Let's just go ahead and print out, right? Because then we simply just don't have enough data to actually start filling up these roll windows. So then we can print, sample smaller than roll window, and let's just return something, right? Just so we sort of know what's going on. Yeah, and now we can just jump right into a rolling regression. So of course, there's a bunch of different ways to do this. I'm just going to do it in one of the 100 different ways. You're free to, of course, change this later. But if we think about it, right, we're going to have this sort of data so there is something. So right now, this is a data frame. This essentially has like 2 dimensions, right? We have the columns and the rows. There is something called like a multi-index data frame. I think we might have covered that a little bit in the stochastic modeling video. There's a bunch of different ways to do things. What I'm going to do for now, just to make things really easy, is I'm literally just going to define a Python dictionary, right? This is not a Pandas or NumPy object. This is literally just a Python dictionary. And then we're going to be able to, at the end of this, index into results of the ticker. So results of AVUV, or results of VTI, and then each item in the dictionary is then going to be a time series of just, factor loadings just for that single single ticker. That's also going to make it easier to plot as well, since ideally we want a different plot for every single ticker separately. So that's just what I'm going to do for now. So we are going to need a nested loop in this case. So the first thing we're going to do is we're just going to loop over all of our tickers, right? All of our securities. So of course we're using ret access, or rets access. So I'm just going to say for ret access in rets access. Maybe that's confusing, right? For a singular access return within this thing of, multiple different tickers worth of access returns. We're just going to at first do this on a per security basis, right? A per ticker basis. And then for each one, I'm just going to define a variable maybe called, factor loadings per window. And again, to keep things simple, I'm just going to make this a regular Python list. We're essentially just going to run a regression for each individual ticker. And then, each one of these objects with only one column, we're just going to store as each item in this list. And then when we're done with the loop, we'll just cast the whole thing into a data frame. And then we're going to store a bunch of those in this dictionary, if that makes sense. Now, again, normally you want to avoid nested loops. Maybe I'll even upload like a short or something later on where we vectorize this. It almost goes against the principles. Again, I just want to make things simple. And then we need to now loop over our windows. So now we can say, for win in windows. And now we can actually do the regression. So we can just borrow, let's say, these 2 lines for now. Let's put those there. So now we're going to do this on ret instead of rets. We're just going to do it on a single ticker at a time. And we can just leave that as that model. And this is good for now. And now we actually need to slice into our window. So this obviously is going to do the entire sample at once, but we want to run one of these regressions for each window. So we're just going to need to go ahead and do some very simple pandas slicing here. So we can go ahead. And in fact, when we loop over this stuff, it's actually, I can just show you now, if we do like for ret in rets, print ret, it's just going to be the name of the column. So we're literally just getting names of columns here. So, we would need to do print rets of ret if you want to get the actual underlying data. So we can do, let me just think here. What was I doing? Yeah, so instead of ret access, so we're going to have to say rets excess of ret excess, right? And then we can just go ahead and do iloc for integer location. And then we're actually going to slice out, the first 36 months of this. And then we're going to, keep on doing that every single time this window loops. So let's go ahead and do, from window of 0. If you remember how windows looked, they were essentially like tuples. It's like start and then the ending point for that one window, like 0 to 36, right? So the starting one is going to be window of 0, and then we're going to slice until window of 1. And that's really all we need to do. And then we're just going to do that exact same thing for the actual factor model as well. And that's really all we need to do for the time being. That's essentially going to take care of everything for us. And then what we're going to need to do is we're just going to need to sort of deal with some housekeeping stuff like the date and the index and stuff. It's really no big deal. The hard work technically is already done. So let's go ahead and do factor loadings of date. And again, I'm blazing through this. You can pause and do this more slowly. And again, there's a bunch of different ways to do this, but we want to keep track of the date. Now, the date for each window, right? Like that first data point is going to be 36 months of data. It's really up to you if you want to do the start date of the window or the end date of the window. For me, I'm just going to do the end date of the window. So if I see a data point that says 2020, that means that, the sample ended in 2020 and contained data from 2019 and from 2018, right? That's just what I'm going to do. So let's set the date equal to rets excess dot index, and then we're going to go into window of 1, and then we are just going to need a -1 just because we had a +1 here, just because when we slice, it's like inclusive, exclusive. Again, you don't need to worry about that, but you can test this yourself. That's just going to be so we have a date. And now let's go into factor loadings per window, and then we're going to append this object, right? So this starts out being empty. We're literally doing the OLS regression. We're literally just putting a date in it. And now we are appending each one of the things that we had before, right? Each one of these, except there'll only be one ticker, right? This whole thing will be contained within this regular Python list. And that's really all we need to do. And now we can go outside of this nested loop. Once we're done with all of our windows, now we can go ahead and we can do results, which is the dictionary. And then again, we're going to index into ret excess, which is just the name of the ticker that we're doing. And then there is a built-in sort of thing when we do casting here. It makes it pretty easy for us to cast from a list to a data frame. So we're just going to do PD data frame, and we are literally just going to cast this Python list into a data frame directly. And then the one thing that we're missing here is we just want to do a set index on the date we defined, just so we make sure that date isn't a regular field. We want date to specifically be the index of the data frame. And when you go through this, you can put in print statements and see what's going on. Again, this is just one way of doing it. And then that's really all we need to do. And then when we're done, we can just go ahead and return results. And hopefully we did this right. It should be good. Let's go ahead and define the function. And let's go ahead and actually do a function call. And let's see what we get back. So let's run this. Okay, good, no errors. It looks like it worked, and now you can see what I'm talking about, right? The very first thing we have in here is AVUV. In fact, we can just index into AVUV just so we can see what's going on. And we're gonna have, one of these objects for every single ticker, and now the end dates here, right? AVUV data, I believe, started in like 2019. So now we're seeing 2022, which is 3 years later, since we're looking at the end date. And now we have the coefficients, right? These are the factor loadings for a 36-month sample ending in September 2022. And now these are the factor loadings for a 36-month sample ending in October 2022. This is how we can interpret this. And now we can go ahead and we can actually plot this. So let me just save this whole massive dictionary into something called results. And now let's go through and let's just say for ticker in results. And let's just print ticker out first of all, just so you can see what we have, right? We're just looping over each ticker here. And let's go ahead and let's think about what we want to do. So we just want to plot everything. Let me just think here. So yeah, so let's go ahead and do results. And of course you could do dot values, dot keys, whatever. But let's just do results of ticker. Let's print that. That's just going to give us every single individual data frame in each loop iteration. So let's have that, and then let's go ahead and get this done. So let's go ahead and then say just dot plot, except, well, first of all, let's do this, and this should work. Perfect. Okay. Yeah. So this is, you can sort of see how now it's actually pretty easy. We have 3 different plots since we're iterating for each ticker and then doing the results of ticker. So the first one here is AVUV, and we're actually going to put a title on these because right now we don't even know what we're looking at. There's also not that much data here. I'm actually going to kick out AVUV just so we can have more data later. But let's go ahead. There's a parameter here to the dot plot method called title. So if I just do a title, we can now see that we have a title. And again, if you watch the stochastic modeling video, we did a bunch of Matplotlib stuff, though I don't even think we had a title in that case. But let's go ahead and make this equal to a format string. And let's set the title to some useful information. So first of all, we obviously need to know the ticker of the plot we're looking at. So that's going to say AVUV. So that's going to be the ticker. And the second thing is maybe we want the actual total sample. Just if we want that. If you want to get the sample, we can go ahead and say, rets dot index of 0, and then this spans to, rets dot index of 1. And this is now going to say 2022. This is now going to say 2019. This is just the total amount of the total amount of data that went into the sample. Maybe we just want to view that at a glance. Let's go ahead and run this now. Right, sure enough, it starts in 2019, and this is what we have. So now we can see, and if we interpret this, it's actually pretty useful. So AVUV, as I said, is a long-only fund. So even though it's tilted toward value and size and all that, it still is going to be dominated by market risk. So we can see the market is pretty constant, slightly above 1, a little more sort of loaded on market. And then obviously it's a small cap fund. There's a lot of size. There's a lot of value. But we can see that it recently got more concentrated in small caps and a little less concentrated in value. Of course, this is a tiny sample, so it might not mean that much, but it's cool to see. Of course, it loads on profitability, and then we can see the momentum and the investment. Value, on the other hand, we can see loads on value, but then size, it doesn't really load on size. Since this is just a large cap and mid cap, I think, or a global value fund, it's not a small cap value fund. So we're seeing exactly what we saw with the regression. It's just plotted now. And this makes absolute sense for just total US market. By definition, if you really did any country's market over any sample, this is what you should see. Obviously, market should almost perfectly load on market, and should almost perfectly not load on every single other factor just by definition. So this is really beautiful. This is really a good analysis. And then if we want to, for example, maybe kick out AVUV just to have more data, maybe do, I don't know, SPY, or let's actually do some factor funds. iShares has these like factor funds. VLUE is one of them, and MTUM is one of them. So if we do these sort of factor funds, and now give this a run. Right now we have a little more data here. Now we're going back to 2013, and again, you can even go back further if you want. But if you look at the momentum fund, again, all of these are long only funds. They should all have market be more or less almost 1 over time. But now we can see that by far the biggest thing that the momentum MTUM fund loads on is the momentum factor, which makes absolute sense. And you can see how they drift over time, but because this targets momentum mechanically, it won't really drift. Maybe I'll leave it as an exercise to the viewer to go and pull a traditional active managed fund, and then you might be able to see real factor drift, right? VLUE, of course, we saw VTI, right? So that's cool. I just didn't want to upload a video on factor regressions and leave out rolling regressions, since this is obviously quite helpful. I'm probably going to upload the video and still be upset that I forgot to mention some things, but yeah, this is obviously cool and obviously important. So there we go. Okay, so that brings us to the end of probably the longest video ever on my channel. If you even click this video, that's kind of crazy, but if you made it to the end, I love you. I mean, that's kind of crazy if you watch the whole thing. If you did, let me know. But just because I know I'm going to get comments, and just to address the elephant in the room, I know people are going to comment about that, because anytime I go on cam, ever, like we're talking for like job interviews, every house I've lived in, I always get a squat rack. It's like $50 from Amazon. I always get a squat rack. You just screw it together, get the rings. I do calisthenics. I've been doing it for a while. You know, we're obviously jacked. Obviously natural. Obviously, I just like train calisthenics and stuff. I mean, I literally like coded a whole nutrition app a while ago. But yeah, I'm training like one arm handstand right now is what I'm trying to train, and the levers and planche and stuff for like isometrics. We got parallettes and stuff. Oh yeah, and then I ride bikes wherever you can see that the helmet. We ride bikes and stuff too, you know. But yeah, so I think that's everything. I was actually preparing for my next video. I just got this webcam. I don't know if the cable's gonna let me show it, but I just got this laptop. This is my current laptop. I just got this like a month ago. This has like a 5080 and a 24-core CPU. It's actually pretty decent. It's a Legion. But I was planning my next video. I'm like a network engineer major in school. I'm losing my train of thought here. But yeah, I was a network engineering major / cybersecurity major in school for my undergrad. So I've been doing like packet injection stuff like Wireshark, and then packet injection with Scapy and stuff in Python. That's like bread and butter for me. So I was actually thinking about making a packet injection video, either just a generic one about how to do, you know, some spoofing stuff, or even recreating an actual attack. So I was setting up right now. I got my main laptop, and then that's my old laptop. And I have them both connected to the same layer 2 switch. So I was actually going to try and, you know, use this as an attacker machine and open up Wireshark and Scapy and run maybe like an IPv6 Slack attack and spoof some packets and whatnot, and then try to essentially have this be like the victim machine. So yeah, that was one idea I was kind of just writing a little code for and stuff in the meantime. But yeah, so that's it. As always, thanks for watching.